Yeah, I enjoyed it last night. Thanks.
I wonder who's going to play first and who's going to play last. That's so cool. Might actually play.
They got to build a set, construction.
Y'all can get there 5 and be a long time. We represent
Oh, okay.
Like our Ways and Means Committee will be right at home here, just like room 133 with all these folks in the building. But Chairman Huffstedler, I'm Shaw Blackman. We would like to welcome you, and it's good to be in Athens, Georgia. I think we have a couple of folks that are going to get us kicked off here today. Dr. Daniel, thank you for hosting us at Athens Technical College. There you are over there. Would you like to say a few words to us this morning?
Good morning, everyone. Welcome to Athens Technical College. We are so glad to have each of you here today. We appreciate the support that our legislators on the Senate side and the House side give to us each and every day. I appreciate my delegation. Many of you are here today. And thank you for what you help us do with workforce development. That is our mission. That's what we're here to do. Please help us spread the word. Our enrollment, I'm going to brag up for just 1 second. Our enrollment is up almost 9% this term. And out of all the 22 technical colleges, we have a 31.4% increase in graduates, the highest of any technical college. So thank you so much for your support. It would not be possible for us to do what we do without the support of the legislators who are here today. So thank you again.
Thank you so much, Dr. Daniel. Thank you for all y'all do. And we also have the Dean of the Grady College of Mass Communication and Journalism over at the University of Georgia, Dr. Charles Davis, is with us this morning. Thank you for being here. Go Dogs.
Go Dogs. Absolutely, my pleasure. Welcome, everybody. It's a packed house. I have just the briefest story to tell you about why I am here. And the importance of the film industry in Georgia to the work that we do at Grady College. I took this job 11 years ago, which still sounds strange to say, but 11 years ago took this job. And when I got to UGA, we were doing extraordinarily little in the realm of film and television production. It did not take a rocket scientist to figure out that we needed to be doing a lot more. So we set out to start beefing up our film and TV production. And almost immediately, we were approached by representatives from what was then Pinewood, now Trilith, our friends Dan and Kathy, and others down south of Atlanta. And they said, would you be interested in building an MFA program, a Master of Fine Arts product in film and TV production? And we said, yeah, of course we would. We don't know how, but we'll figure it out as we go. We were getting a wave of retirements about that time, so I started converting what were other faculty members in other disciplines to film and TV production. So we hired cinematographers and lighters, and screenwriters and showrunners and producers. Long story short, today we have 14 faculty in a department called Entertainment and Media Studies, which is wholly dedicated to film and television production. Our goal is to produce Georgians for Georgia jobs. And it's working, long story short. 3 years into that endeavor, we were approached by our friend Joel Harbor. Where's Joel? He's somewhere around here. Joel Harbor approached us and said, I'm going to build a soundstage complex just north of Athens off the bypass. I'm going to call it Athena Studios. And then he asked me the strangest question ever. Would you be interested if I built you a soundstage? That was a funny conversation. I remember it well because I said, yes, please. That would be fine. Joel was not kidding. Today we sit at Athena Studios right off the bypass here in a 14,000 square foot soundstage. Many of you are going to see later today, I know. Our students adore it. We are producing film and television there on a daily basis with our MFA and our undergraduate students. I say that by way of underscoring the fact that none of this would exist were it not for the growth of the film industry in the state of Georgia. We wouldn't be there. We would still be a program that were really producing folks for jobs that didn't exist. So we are so excited to be here and thrilled to see you all, and just excited that you're in Athens. So welcome.
Thank you so much, Dr. Davis. And joining me with greetings as well is Mayor of Athens, Clark, and Mayor Gertz.
Thank you, Chairman. Welcome to Athens, everyone. Or welcome back in many cases, I know. Folks have spent some of their glory years here, and we're really glad to have you back under any circumstances. I've promised the chairman I'm not going to call the fire inspector on this room, so hopefully you'll be safe and secure for some period of time. I really want to thank members of the General Assembly. I think many folks in the state think they work for 40 days a year and that's it, and I think they're demonstrating today that they're spending their time and sweat every day throughout this year taking care of the good folks who we love so dearly in our state.
Thank you, Mayor. It's good to be in Athens. So also want to thank our panelists and let them introduce themselves. Chairman Huffstedler, if that's okay. We can start with you or start with me, and then I'll go to you. I'll hand it off to you. Shaw Blackman. I'm from Houston County, right in middle Georgia, and this may be a little corny, but my favorite film growing up was The Natural. So anybody else wants to share theirs, feel free to do so.
All right. Is mic on here? Yes. All right. Thank you. Chuck Huffstedler, his counterpart in the Senate, Chair of the Finance Committee out of Rome, Georgia. And well, the last movie I saw, I was flying back from overseas Monday, and it was the last Harrison Ford film. And I always liked his humor and action adventure combination in all his movies. So I like those a lot. He filmed one in Rome, Georgia years ago. It did terrible. Wow. Other than that, he's done well.
Good morning, John Albers, Senate District 56, Cobb, Cherokee, and Fulton County Vice Chair of Finance. And favorite movie, I will go with Remember the Titans.
Bill Calsert, represent Athens. It's so good to have everybody in the classic city today and enjoy Athens Technical's campus, which is much hidden secret, we think, here. It's producing lots of people, work-ready workforce. I got to go with It's a Wonderful Life. I still see it every Christmas and cry every time. Go start.
My name is Chuck Martin. I represent the 49th District in North Fulton County. It's portions of Roswell, Milton, and Alpharetta. And I'm going to go back old school. I like John Wayne when they did the Green Beret movie. I just thought it was a good film for our military.
Thank you. I'm Matt Hatchett from Dublin, represent Lawrence and Johnson County, Chair of the House Appropriations. I'm sitting down here with my colleague and cohort, and we're going to keep the tables balanced down here. My favorite movie is probably the good old Forrest Gump.
I'm Blake Tillery. I'm from Vidalia. I represent 11 counties in Southeast Georgia. I'm sitting down here to help box the House in a little bit on an issue. And my favorite movie would be Tombstone. I can quote it from beginning to end. I hear that Kurt Russell's been playing a hoopy. So, Kurt, if you're watching today, when you land next time, let me know. I'll meet you at the airport.
Awesome. So I believe we have the Department of Revenue to get us kicked off here today. Is that Mr. Gibbons? Yeah. And we'll turn the floor over to you, sir.
Thank you, Mr. Chairman and committee members. I'm Austin Gibbons. I serve as the Director of External Affairs and Communications at the Department of Revenue. My favorite movie is about the great philosopher Forrest Gump. And so I guess the legislature is also like a box of chocolates and you never know what you're going to get. So I'm really just stalling at this point while we get our presentation up, but I'm joined today by Deputy State Revenue Commissioner Chester Cook and our Director of Income Tax Policy, Kelsey Finn. They'll be leading our presentation. We just want to give you an overall view of the film tax credit from the department's perspective, specifically the film tax audit process. And we have a couple QR codes throughout the slide deck that will take you to different portions of our website that the committee and the audience might find relevant. So with that, I'll hand it over to Chester and Kelsey.
Thank you. Is this working? There we go. So thank you. Appreciate the opportunity to talk a little bit about the film tax credit. Obviously, with some legislation, other changes the past few years, there's been a good number of changes. So we're certainly glad to talk about what the department does in terms of administering the film tax credit. So just a couple high level things. Basically, to qualify for the film tax credit, the nuts and bolts are you have to spend $500,000 on qualified expenses that are Georgia expenses. And to do that, then you're eligible for the 20% base tax credit, which is what everyone gets that qualifies. And then if the production has certain promotional activities, such as the Georgia Peach at the end or other activities that are approved by the Department of Economic Development, there's a 10% uplift. For the most part, most projects typically end up qualifying for the 30% total. And then the production company is simply generally the entity that's producing the film in terms of shooting the films. It can be a pilot, series, television, commercials, videos. As long as it's something that's going to, at least for the 10% uplift, be distributed and must be distributed somewhere. Doesn't include news, athletic events, local interest programming, instructional videos, or corporate videos. Just a little history. The credit began in 2005, and then there were some changes in 2008. The 20% credit came into play with a 10% uplift. Then in 2013, a couple changes. There was a sales tax exemption in place for certain equipment used at the filming site. That was removed, and then a requirement was added, which is a big, what I'll put as a big compliance requirement for the program, is to put mandatory withholding on loan outs. Basically, loan outs are the talent. So most of the talent have their own company. It's called a loan out company. So when they do work for a production company, we require that they withhold on the gross amount that they pay to the production, to that particular loan out at the statutory tax rate. So we get the gross amount, and then ultimately those folks will end up filing their own returns to determine what their real liability is. Whether they file or not, the state actually has the money up front. So if they don't file, we already have our money. So that's a really important compliance piece of what the department does and part of the program. In 2016, a bill passed to allow credits to be certified electronically. That's a big piece for DOR. We're essentially a big technology company. We're heavily reliant on technology. So the advantages, of course, are that all the transactions for both the generation as well as the transfer of the credits is all handled electronically through a process of what we call the IT trans. It's extremely efficient. So as soon as those come in, the system does the work. It matches the certificates. Inside our system itself, what we do to track credits, we do really a couple things. We receive a file from Economic Development every month that tells us what projects are approved directly. We load that in our system. It has the tax number, the name of the project, the company. So we can match that up when folks come in for their returns or when they come in for their audit to determine when they're qualified. They've been qualified from Economic Development. Also, it lets us know whether they've received the 10% uplift or not, so that we know the appropriate credit to apply. And then it allows everyone to self-serve and transfer credits at their will without having to put it on the return or do any manual work by DOR. So it's a really, really effective and efficient process. In 2020, House Bill 1037 changed the landscape quite a bit for film tax credits and the audit program in particular. That bill was a result of a performance audit that was completed by the Department of Audits on the film tax program. And it had several recommendations in there: employ third-party auditors, have the department still ultimately review and sign off on the credits, use sampling methods for the audits. A few other things that DOR actually suspected that methodology and process was already coming. In fact, before 1037, the department was already ready to ramp up a pilot program to allow third-party auditors to do the work, because the demand for production companies to want their production audited was really growing. The department has always had a voluntary audit where someone can come to us and say, please audit me, tell me what that final number is, and then we'll issue a final certificate on what that is, which is in the industry often referred to as the golden ticket. So that just grew. So we were already working on that when 1037 came in, which also allowed us to step that program up relatively quick because we had the infrastructure in place to do that, since we were already willing to do that. So as part of that, 1037 on a phased-in approach requires all productions to go through a mandatory audit. That's very similar to what happens in other states. So we knew that was coming as well, and that was something the department was going to a certain extent, move forward in terms of third-party auditors, since most people are going to end up using them anyways. So that requires that beginning in 2023. Now all projects have to undergo an audit. It began in 2021, and there was a phase-in for the large projects first, as well as kind of a middle ground, and then the smaller projects. Along with that, also the bill created a certification program for the department, for the third-party auditors that want to conduct it and conduct departments or conduct the audits on behalf of the department have to go through some DOR training. We've partnered with a national group, the Multi-State Tax Commission, where we developed the sampling methods for this. And to date, we have 5 firms that are certified. We currently are undergoing a training program right now to certify more. There's another 6 or 7 firms that want to take the training to get certified to conduct the audits. And on top of that, other states are also interested. For example, the state of Montana is taking that training right now. And in terms of what we do in our audit program and the Film Tax Credit Administration in general, other states have looked at what we've done and they've reached out. We've talked to South Carolina, we've talked to Illinois, and California has also reached out to us recently to talk about our program. The other thing that it also provided with 1037 is, since the department signs off on the final number, that allows the production company to go ahead, and if they disagree with the results, there's still their due process available. If they disagree with the audit, they can file a protest, as they can for any other sort of tax or agency action that goes on. Previously, the way it worked was slightly different before 1037 because the rights to a certain extent were actually with the purchaser of the credit. So there was a little bit of a disconnect there where the production companies were the ones audited, but the impacts were to the purchasers. But this put a clear path for production companies to protest the audit findings. This is just sort of the overview of the agency involvement. Again, Department of Economic Development certifies the projects. And once they do that, we're provided a list. Department of Economic Development handles the promotional piece, so they determine the 10% uplift, and then they let us know about an electronic file that we receive every month. And then we conduct audits of all of the credits. Some production companies, they're welcome to choose the department to conduct their audit. If not, then there's a list of third party that they can request, and then the department will ultimately make the approval or disapproval or assignment of the audit firm that performs the audit. That's currently within the department's statutory ability to determine who that is. And then also the department conducts administrative appeals. In terms of the film group, currently we have 11 auditors, and then that are DOR employees, and then that's of course augmented by currently 5 CPA firms, and we expect that to increase here in the near future. One kind of important thing, whether we talk about where we started a voluntary audit program to allow people to come in to voluntarily be audited, or whether it was related to the mandatory audits, the department has a fee schedule for that and always has. So the auditors in the audit program itself for this are completely funded by fees paid by the industry for the audit program. So the auditors themselves are covered by that. So that's not, the state doesn't actually appropriate funds for those auditors. It's a self-managed, self-funded program. And again, they conduct audits of the production expenditures, approve and finalize the certificates that we issue. We issue 1 certificate per project, and then that can be transferred, or pieces of it, to purchasers. And in our system, we can track that from cradle to grave, from the creation to the individual certificate to any individual that purchased or is transferred a credit. That is a unique certificate that can only be used once, that is managed on that taxpayer's account. So there is no other way to, for example, file a tax return and claim a tax credit that you don't have. There is a certificate across all of our tax credits the way we manage it, 1 certificate per person, per credit. So that allows us both to track what's on the books, what a taxpayer can take, how long the carry forward can go forward. And of course, that's also a really strong internal control from a fraud perspective, that we control, we assign, everything is unique, and there's a 1 per there. So there can't be any duplicate claims of credits. And once we go through the audit, we kind of document everything, whether it's a mandatory, voluntary, or involuntary, and then we provide the usual monthly reports that we receive on how many projects are in, how many we completed, how much did we issue, what are the projects, those kinds of things. So once dollars come up over a certain threshold, the audits from the audit itself, the staff get reviewed at a higher level because we have thresholds within the department for approvals as any other organization would in terms of dollar thresholds to approve credits. And then, of course, transfers, credits between transfers, transferees, and then we oversee the certified audit program. And I'll let Kelsey talk a little bit here, just some visual stuff about the life cycle of the film tax credit.
Let's see if you guys can hear me. So yeah, I'm going to walk through the basically the process for the film tax credit. All productions start out at GDEC and they get certified. And the next stage is the actual film itself. So there's pre-production, principal photography, and post-production. Following post-production, the production will submit their audit application to the department. So they begin their mandatory audit with either us or the third-party auditor. And regardless, the production company submits all their documentation and their audit workbook. So that's available on the website. They fill it out and the auditors review it. The auditors review the expenses and they calculate the days worked in Georgia and out of Georgia to determine which ones will qualify. And then they make adjustments and exclude any unqualified expenditures. So, and the credit is calculated at 20% of the qualified expenditures. The unqualified expenditures are taken out of that total. And if it went through a third-party audit, then the department will review that after the completion of that audit. And if the department disagrees with those findings, we have the right to adjust the audit and the credit calculation. So if GDEC determined that they met the requirements for the 10% uplift, then they let us know, and we then calculate that 10% off of the qualified expenditures, same value that the 20% is calculated at. And then if the production company disagrees with our audit findings, they can appeal those audit findings to the Office of Tax Policy, which is my team, so they get to work with me. Then they report the credit on their income tax return, and they can either transfer the credit using the IT transform or use the credit against their income tax liability. So initiating the audit, the production company's responsibilities are completing the application and submitting the audit payment. And then they can decide between working with us or third-party auditor with our review after that audit. Department's responsibilities are assigning an audit to begin those audit procedures and adhering to the audit's procedures manual. And if you guys want to use this QR code, it has a list of all of the documentation, or this is the audit procedures manual, so Austin has copies for the committee. But this QR code will take you to the manual and show all of our procedures and required documentation and how the audit works.
And again, so once the production company provides all the required documents, then the audit kind of begins whether it's DOR or not. And here's a link to qualified. Expenditures underqualified could be the type of expense, one that isn't allowed under the code, or the type of expense where it's occurred. So, for example, if it's not a Georgia vendor, or it's for time. For example, for the talent, part of the time spent out of state, we don't allow the total salary or funds that are paid to the talent to qualify, only the piece for example, for the days that are in Georgia and for the work performed in Georgia. So certain other things, promotional days and other things aren't allowable under the credit. Again, here's some examples, some things that, some common things that don't qualify: marketing, publicity, story rights, distribution, expenditure for work or not conducted or rendered in Georgia, and then expenditures for goods that were not purchased or rendered from a Georgia vendor. What we do is we have for example, for someone's renting equipment, they will have a sales tax number. They're required to have a sales tax number. We have a lookup tool that the auditors can use, the third-party auditors or others, or the production companies themselves can look up to verify the sales tax registration and that the sales tax registration was in place during the time for which the transaction occurred. In other words, if they're renting property, they're supposed to have sales tax registration, then they should have one during the period which the expense recurs. So they can verify that on our website. So that's pretty easy. One of the other requirements that's in the audit procedures manual is we look for local business licenses, because if you're doing business, you should have a local business license. So part of our audit procedures are determining that there's an active business license during the period for which the expense occurred. And in our experience, we do, for example, for counties and cities, we have a program outside the sales tax program counties can participate in to match business license registrations against sales tax registrations. So we can identify non-filers. Our experience is that if you have a local business license, it is darn near 100% you'll have your tax registrations. So that's a really good important control in terms of looking up, making sure they have a business license, and then making sure they have the sales tax registration. So those are things that are easily available. So the productions will document that from the vendors they do business with. A little bit on Georgia Vendor, sells, rents, services in the ordinary course of business, has a physical location. If it's tangible personal property, they'll be required to collect sales tax, and again, has a local business license. These are the things you would expect that someone doing business, holding themselves out doing business, would have. So that's part of that. That's defined a little bit both in our regulation and then extensively in our audit procedures manual. There is an exception for certain services that are provided on the site. So such as say box rentals, I guess would be a good example of that. For individuals performing services on the site, there is an exception that it will qualify. However, there's also, similar to loan outs, there's a mandatory withholding on those, which means we get gross withholdings on those pay. So if it's someone that comes in and goes out, although it may qualify, we're going to get the gross amount of tax that was due from an income tax perspective on that. And then that person can file their income tax return. Maybe they owe that, maybe they owe more, maybe they owe less. But we got gross withholdings at the full statutory rate on the work on site. If they don't do that and they don't do withholding, we disallow the expense. And then again, finalizing, we talked a little bit about, we review the third-party audits, issue the certifications for the final number that goes on there. There are some, which I think will be addressed a little bit in the next presentation in terms of the timing differences from 1037 to what it was before. Before 1037, projects didn't require mandatory audit, and then the tax credits were generated in 1 year and had a 5-year carry forward. Now under 1037, the tax credit isn't issued until the audit is approved and the certification is issued by the Department of Revenue. When that happens, that becomes the tax year that the credit is effective for. So for example, if it was a 22 project that required a mandatory audit and we issued the certificate today, that would be a 23 credit that could then be claimed against a 23 return beginning next year. And one of the other changes is the 5-year carry forward also was a timing shift. Now that's a 3-year carry forward rather than what was a 5-year carry forward. And again, what's on the letter, the amount of qualified expenses is issued on there, the film tax amount, and then the certificate number that'll match to the income tax return. So when they claim when they file their income tax return and they put that certificate number on there, we can match and validate that it's there and how much is left, how much has been transferred. We keep a ledger for every credit in the system on every single taxpayer, and also tells us the tax year to be used. So for example, if it's a 23 credit we issue today, that can't be used against a 22 liability. It can be used against a 23 going forward. Current credits, or even under the previous regime before, the years that it was created for which the production approvals were issued by economic development determined the tax year, but even then they couldn't be carried back to prior years. And again, we've got codes we use for all of our credits. We have over 50 tax codes. 122 is the one for film, and they report what's earned. They have schedules for available years. We have those schedules as well. We keep a ledger for each one of them. So once it's used, it shows it's used. We can track who it went to. Also, once someone makes a transfer and they make a sale, it is irrevocable. So that's kind of the way that works. So if someone purchases, for example, too many tax credits, the transaction is done. They can't just reverse that back. So transactions can't move back and forth between buyers and sellers. So where we are basically, high level is with the audit procedures we put in that uses sampling, we very closely followed the performance audit that was completed by the Department of Audits. We looked at what other states did, and then we came up with standardized training for the sampling. We use pretty robust sampling techniques, as I think you'll hear about later. And then we also provide the software that's used for the sampling. So everything is done the same way. So when we review stuff, we can see what was done, how the sample was, that it followed the methods. We do have certain exceptions where we break out some of the categories of expenses that we like to see. For example, the DOR or the accounting firms will have to look at sort of the deal memos, which are the agreements with the talent and the production company, and they review those so they can look for things that may be in there that wouldn't qualify for the film tax credit. Maybe there's certain benefits or spousal benefits, other things that come with it that are part of that. So we look in there for pieces and things that wouldn't necessarily qualify. We also segregate out certain expenses. Airline fares, for example, we allow sort of typically one per episode, or for the most part. So that sort of puts a bit of a stopgap on, folks just flying in and out every week and doing that. So that we disallow that. The other piece, which is covered in the regulation the department issued a number of years ago, as it relates to hotel fees, we follow GSA per diem. So in other words, if they're reporting or claiming an expense for a hotel, we look to see that it doesn't exceed the GSA per diem there. So that's part, whether DOR does it or a third-party auditor does that, that's part of the audit procedures. So it's really robust and a tight program. Someone asked me, we were talking the other day, hey, what would it take, what could you do to strengthen this program where we are now? And my response is basically the only way that the department could strengthen this is if they did the accounting for the production companies at this point. That's kind of where we are. We're a couple years in, everything's mandatory now. Currently, we have a little over 140 mandatory audits in the pipeline that DOR is working or our third-party firms are working. As they come in, we're working them fairly quickly. We're turning those around typically 4 to 6 weeks. The credits are getting out. And again, as we go through that, we'll go back and take a look at what our procedures are. We may decide to tweak a few changes as it relates to sampling. We wanted to drive the vehicle for a while, see what we liked and disliked about it. And we may make some minor changes, things such as maybe for smaller projects, we take a look at what the thresholds are for certain items that, again, are changes that just to continually add to the efficiency, but nothing that would reduce the integrity of the program or the audit process. So that's a point for which the department is not willing to go beyond that if we think it impacts the quality or accuracy of the audits. And again, we think because we're getting so many questions from other states, we think we've got a good program. Other people are taking our training now. So in terms of that, in the administration of the program, particularly since we use a lot of technology, it's very fast, very efficient. So from an administrative perspective, certainly the department, we don't lose sleep over anything because we think it's tight, it's efficient. So that's kind of where we are from a film tax perspective. I'm certainly glad to take any questions.
Are there any questions of the department? Chairman Hatch.
Thank you, Mr. Chairman. I want to share a question from one of our members that's not present. He is presently Zooming from the coast of Belize. So I'm not going to say his name, but y'all can imagine who's not here. His question is, can we get information that shows how much loan out companies are eventually refunded?
Yeah, that is difficult. So here's the way that typically works. Let me explain why. You have the loan out companies which have their own withholding registrations, just like anyone else. Some may have a film, so they have a loan, so they'll withhold on the loan out. The production will. They'll issue the tax forms to the loan out company, who will then claim it. Most of those are pass-through entities, so those end up on individual income tax returns. So there's 2 steps away from ultimately where that withholding is claimed. And there isn't necessarily, because there can be many loan outs, one-to-one. We don't capture every loan out in terms of what their number are to match ultimately what's claimed, whether they file a return or not. We're concerned that the withholding occurs at the point there and that we got our funds. So because people file paper, there isn't really a good way to track that. So we don't have a specific number on that. Historically, at least during the performance audit that was done in terms of expenses, typically from a production perspective, loan outs typically run, probably 60-65% of total expenses, maybe a little more, a little less.
To follow up on that, with the loan out companies, they could be structured as a corporation, as an LLC. They could be structured however, and if they file a return in Georgia, that we are a 3-factor state. So correct, right? So if they file a return in Georgia, based on their hours in the state, based on if they file, you can remind me how to exactly refer to the 3 factors. It's income, employees, et cetera, of the whole business. They could apportion themselves where they have very little of that revenue, that income coming for the state, and reduce their taxes to almost zero using the 3-factor system, could they not? If they go to the trouble to file a return, could they not get almost all the money back if they were properly educated toward our 3-factor system and how to best use it, best to implement it?
Sure. So let me explain a little bit. So at one point, from a corporate perspective, we were a 3-factor. We're a single sales factor state now. Right. Which, of course, if you're talking about, an LLC or corporate, the loan out, so they also could follow similarly. So they will likely pass through in their individual file, typically because we're collecting gross. So in most situations, they would be due a refund anyways, because they have certain expenses and other things they could normally deduct, personal exemptions, those kinds of things. But because the way the apportion works, they would be able to apportion their income for what's in Georgia and without, and that's the same way other states would work. So they would most assuredly still owe us money. The question of how much that is depends on how much with it in Georgia or how much is not. But that's no different than any other, the way any other individual or other business would work. But they would have it. Mr. Stavoulis, Peter. Right, they would file the Georgia return based on their income in Georgia, and then they would get a credit in the other state. So,
and that's what I was trying to ascertain. So there's not a way that it could be a portion where.
Yeah, on the individual income tax return, we do have the Georgia income amount and the everywhere income amount.
Okay, that's fine. I wanted to ask a question that could be done like that.
Yeah.
But they're not limited in what expenses they could write off against that income.
They would be limited to the same expenses anyone else could write off in Georgia based on our adoption of the federal code or any Georgia-specific exceptions to that and subject to audit.
Yeah, legal expenses.
Sure.
It's not limited if they.
We're a little behind schedule, so if there aren't any questions
ask
from the
one, Mr. Chairman?
panelists, sorry, did
Can I
you
ask
have
one,
one?
Mr.
Oh,
Chairman?
of course, sir. Yes, sir.
Thank you for this. Hopefully I can say this in a way that makes sense, Mr. Cook. I know since about 2015, we've generated about 5.2 billion in credits. I know 4.1 or so have been claimed, so there's 1.1 in outstanding. But you brought up something about 1037 that I hadn't heard before, and I'm wondering what your thoughts are on this. Since the credit is now not able to be obtained until after the audit, I was watching just year after year where you'd see like in 2019, there was 900 million in credits. And then you go to like 2020 and it's 500 million. And 2021, it's 600. Then you have this huge fall off in 2022 down to like 140. Is that because the credit is now not tangible until after the audit? That's the first question. And the second that sort of follows up on that is, so then what is that balloon or backlog to be coming soon that we should expect to see over the next 2 to 3 years as the audits are finished?
Sure. So 1030 definitely will affect the timing in terms of the credit generated because it will be generated later. Prior to 1037, a production company could estimate their expenses, monetize the credit, sell the credit, and then file their income tax return later and true that up for whatever the final amount is. And then those were created in the years basically for certificates issued by economic development. So if I had a project that was issued a certificate in 2019 and 2020, for example, the expenses that occurred in each year would determine the credit amount for each year, and then they would get the 5-year. So that was their. So currently under this, when they're done and after they finish shooting and come to us, or within a year after that, there will be a later delay on when it's been created. So we have, 140 odd productions in the pipeline right now, and we expect there will be certainly more coming in. We take a look and track the file coming from economic development, so we don't know the timing of when they're coming in, so we have an idea of what we think is still outstanding. Now, 22 would certainly have an impact of 1037 because that's the second year in the phase. In the first year, which was 2021, I think the minimum, the spend to get you into the mandatory world was about 8.3 million, I think, if I remember the numbers correctly. And then that went down in 2022. So that picks up a lot of projects. So you're definitely seeing a timing shift there. You could be seeing shifts just in production and other things as studios cycle through their production cycle for some of the larger films as well. So that could also impact it. But there's definitely a shift. What that looks like or when those are going to come in, that's hard to tell. We originally anticipated that later this year there would be a bubble as people came in, and then the push for those projects started to come in as the program was ramping up. But that will lag a little bit because certainly the strikes had a big impact on shooting and what's come in, and certainly what comes into us. So there will be a timing lag. What that looks like and when they will come in is difficult to predict. Certainly some will come in later this year. There should be a good number, several hundred or more, 300-ish. If I had to guess, that probably we would expect to come in 2024. And what the numbers are kind of depends on the size of the projects.
You'd put if there's a bottleneck on the audit, you'd say it's 300 million? Is that what I'm hearing, or is it more?
In terms of what's under audit right now? Or?
Right. I'm asking if there's a bottleneck at the audit now because of 1037. Totally understand that. That explains why I'd have an anomaly in 2022. What is that bottleneck? Even though I understand it's under an audit, what is the highest it could possibly be so we can prepare a budget accordingly?
So it's really a lag. So as soon as either we do it or the third-party CBAs do it, we're turning those around in 6 weeks. So it's really a lag because of the production and the shooting and when things are coming to us. Not that we have we just expected a large amount, so we're prepared to handle that, to work through more than we typically were. Because with a 3-year phase in under 1037, we expected that to happen, and then after that, then it's just sort of smooth 400 projects a year. So it's hard to tell. We would probably have to look back at the dollars of estimated spend that are provided when they get a certificate to shoot that. But our experience is when we get to ultimately what those credits are, and we look at, for example, our numbers on the books versus the estimated spend at the beginning, our numbers are always less by the time we get to that, because that's a pure estimate at the beginning. Yeah. Yeah, and some of that may, in terms of looking out at that horizon, may end up being covered under the Senate Bill 6 piece that's going on with that, because we provided a lot of information to the folks providing that hey, not only is there a timing shift because of 1037, that horizon changes, but we have a list of all the projects, what's come in, what hasn't, that type of stuff.
Thank y'all. Chester, Kelsey, thank you, Austin. Appreciate the information this morning. Next on the agenda, and I know who he is now, is Peter with Bennett Thrasher. And while he's making it up there, I'm going to back up for just a second and apologize because having lived this for a couple of months now, sometimes I forget myself. But as we've gone across the state and we proceed to some other locations, we have focused in on certain sectors of our economy. And as if it was any big, huge secret, film is one of our highlights, or the highlight today. And DOR gave us kind of the 101 on film credits. And now we're going to hear from Peter, and I think he's going to talk a little bit more about 1037. But before I turn it over to you, Peter, we have two panelists that have joined us since we began. And we have been introducing ourselves and sharing our favorite movie. Debbie, if you want to start, you and Doc Rhett.
Every time I get asked a question like that, it's like I go totally blank. But I do love movies, and I have seen Barbie. And maybe that's a good thing to say. I'm Debbie Buckner. I represent House District 137, which is around Columbus, including Columbus, Fort Benning, LaGrange, Troup County, Meriwether County, and Talbot County, my home county. And it's good to be in another technical college. I was in Thomasville yesterday on health issues, so I'm getting a tour of the state and the technical colleges. So thank you.
Senator Rhett, Cobb County. Thank you for this opportunity to be with y'all. My favorite movie is by Burt Reynolds, The Longest Yard.
Thank you both. Peter?
Thank you, Speaker. My name is Peter Stathopoulos. I'm with Bennett Thrasher. I head up the entertainment practice. We're an accounting firm of about 450 people. Our worldwide headquarters is in Cobb County. We are in the top 60 accounting firms in the United States and growing rapidly. And entertainment is one of the industry segments that's significant to our firm. My background is I grew up in DeKalb County, went to University of Georgia Law School, have been working in the entertainment industry since about 2008, have always been involved in economic development. In fact, I actually started my career with the Georgia Department of Revenue. So anyway, the film tax credit program's been kind of a continuation of economic development practice that I've had for years. I think it's an excellent public-private partnership in that my firm works very closely with the Georgia Department of Revenue on performing these mandatory audits. We're one of the currently 5 firms that are deputized by the state to perform these audits. And because this was the first round after House Bill 1037 of doing these audits, there were a lot of questions about how they should be done. So we worked closely with Chester and the rest of his team at the Department of Revenue and kind of how to do these things. So, and it took a while to do. What I'm here to testify about today, well, actually, before I get into that, I forgot favorite movie. My favorite movie is probably the Godfather series. The second one is my favorite. And I very rarely get to meet anybody cool in the entertainment industry because, you know, I'm involved in accounting. But I was driving through traffic one day and I get this call and it was this guy speaking bad Greek to me. And I was like, who the heck is this? I'm of a Greek extraction. I speak Greek. And it was Francis Ford Coppola. So he needed help with something, and it took me a few minutes to figure out, you know, who the heck this was. But that was kind of cool, getting a call out of the blue from the director of one of my favorite movie series. He's here filming a movie in Georgia called Megalopolis, which I look forward to seeing in the future. Back to my testimony. So House Bill 1037 had a material impact on the Georgia Film Tax Credit Program, and some of that impact had the effect of basically reducing the effective rate of the credit. So nominally the credit is 30%, but that is what applies to qualified expenses, which are not the total universe of expenditures made in Georgia. So a production comes here, spends money, some portion of that is not qualified. They apply for the qualified portion, and then on top of that, we perform one of these mandatory audits, and we perform very rigorous testing procedures developed by the Department of Revenue, which results in a further disallowance of the credits. So as I'll get into in more detail in a few minutes, the effective rate of the credit is not 30%. It's much less in terms of the total spend in Georgia. Chester kind of stole my thunder as far as House Bill 1037, but I'll just quickly recap. One of the biggest impacts is the change in timing also changed the value of the credits. Before, a lot of projects shoot over multiple years, and under the old rules before 1037, you would just claim the credit as you go. So you spend some money in year one, you claim those credits in year one. You spend some money in year two, you claim those credits in year two. Under 1037, the timing has now been pushed back to when the mandatory audit is completed. So for a multi-year project, you could be not able to monetize your credits until possibly year 2, 3, or 4, depending on how long the shoot period is and how long the audit is and the final approval by the Department of Revenue. So, just based on a time value of money and net present value, that had kind of a downward effect on the credit benefit. The other thing that changed was the carry forward. So the credits used to have a 5-year carry forward. So you claimed it in the year that you spent the money, and then you could carry them forward for 5 years, or if you sold them, a purchaser could use them for those 5 years. The carry forward period has been scaled back to 3 years now. So we went from a 5-year carry forward period to a 3-year carry forward period. So the useful life of the credits was reduced. Another thing that happened is how we perform these audits and the error projection methodology. So before, let me preface this with our firm does this in multiple states. We started out in Georgia, but we kind of do these film tax credit audits in multiple states, including New York, Louisiana, Virginia, New Mexico, et cetera. The method used by Georgia to calculate the allowable expenses is probably the most conservative in the country that I've run into. So what most jurisdictions do is you sample from a large population of expenses, and then you figure out what the dollar value of those errors is, and then you divide that by the dollar value of the total samples, and you come up with an error rate, which you then apply to reduce that population just using statistical projection methodologies. Georgia uses a more conservative methodology, which is based on you have to calculate using statistical software what the lower confidence limit in the sampled population is using a one-sided 95% confidence interval, and then everything above that is disallowed. So not to get too boring about statistics, but that methodology is different than what other states use and results in a higher disallowance rate. So we typically, on our first few audits that we've completed, have seen disallowance rates as high as 15%, probably averaging about 12 to 15% of what was submitted to us. So once again, the effective rate of the credit is likely less than 30%. The other big change is just record keeping, and just this audit is, once again, probably one of the tightest audit programs, if not the tightest in the country. So we are required to review thousands of records, literally thousands, including 100% of every deal memo for above the line cast and crew. So we have to read the full memo, figure out what the qualified comp is, and then allocate that to Georgia based on the number of days those individuals actually spent working in Georgia versus elsewhere. And then we allocate their expense, and only that allocated amount is what ends up being qualified. And so we commonly disallow stuff for publicity, for instance, because that's not a qualified activity. So if somebody spent a few weeks or a few days doing publicity, that allocates some of their compensation to non-qualified, or they spend some time in development, because development's not a qualified phase of production. So in summary, just wanted to say that I think it's a very tight audit program, and I do think that the true impact of House Bill 1037 is only really just now being realized because of, one, the pandemic and the shutdowns related to that, and two, it took a year or two to develop this audit program by the Georgia Department of Revenue and the CPAs that were deputized to do so. And so we're just kind of seeing the impacts of that program, and so I think it's yet to be determined, the true impact on the program. And with that, I will rest and see if there's any questions.
Yeah, got a couple of questions. Chairman Martin and then Representative Buckner, if that's okay.
Are we on now? Yeah, there we go. You referred to the credit going down. I mean, obviously, we're interested in true facts, and you're in the accounting business, so are you. So, I mean, if you know, being correct based on what the law in 1037, I don't think it's a bad thing, you know, to capture those. But you also mentioned the credit being worth less. Wouldn't you agree that the credit is to shelter income tax?
Yes, sir. It's a
And
tax rate.
since the state income tax has gone from 6 to 5.75, we're headed to 5.49. We hope to get to 4. That in fact, a dollar credit shelters more income at 5.75 and 5.49 than it does at 6. So I mean, in reality, the credit is really worth shelters about 8% more income at 5.75 than it did at 6, right?
Yeah, if there's a reduction in the tax rate in terms of, yes.
It is, there has been, and there's a projected other. So I just want to get back in that when you talk about it's worth less, it's worth more. If it's sheltering income, isn't it true as the rate goes down, the dollar credit is actually worth more?
Yes, to a user or a claimer of the credit.
Thank you.
It seems to me, I'm not the accountant in the room, but so if we have disallowed up to 10 to 15% so far because of the new audit process, is that not a cut to the tax credits available to the film companies? I mean, have we not already kind of done a backdoor film tax credit cut?
In effect, I'm testifying that there was a reduction in value to the production companies in the credit because of the timing and because of the audit and disallowance rates. Yes. Now that impact could be temporary, but yeah, so far.
So far. One more question, please, quick. I know all of these changes because of the House bill have been put into rules and regs through the Department of Revenue.
Yes.
Would it give more confidence to the industry if those were somehow, at least the main points were codified rather than being rules and regs that can be changed easily?
I think the nature. Thank you. It's a great question. I think the nature of film tax credits, because of the variety of expenditures that are involved in a typical spend, it would be very difficult to codify all of the different qualified and non-qualified categories. I think it would be very voluminous legislation. So far, the industry, to my knowledge, is extremely pleased with its relationship with the Department of Revenue. The Department of Revenue has an industry advisory committee, which meets regularly with the Department of Revenue, of which I sit on that advisory committee. And so we feel like the department and the state has been very responsive to the industry's questions and needs regarding this new program.
Thank you.
Mm-hmm.
Hey, I appreciate you being here and your comments, and we certainly want to, work with you as the Senate sponsor of that bill. I feel like I got to speak up a little bit on it, but my thing would be that perhaps there are some things that because they weren't being audited, there were 31 states and only 2 weren't doing the audits. We were one of them. Perhaps there were some things getting through that are not getting through now. And we may be burdensome, but I was with some people last night that sit in California that don't even apply for it because it's so burdensome out there. So I don't want us to be burdensome. I want us to be, fair in this, but, we can certainly work with the DOR. I think they've done a really good job of putting in a system, that makes us feel more comfortable that we're looking out for the taxpayer and, what they're spending.
Yes, Senator, just to clarify, I was not saying that the program is overly burdensome. I think the industry is pleased with the program. It is tighter, that was its intent, I guess, was to tighten up the program, and it's a lot tighter.
It is tighter, but it also creates a certain amount of transparency working together.
Yes, sir.
I got a question, Mr. Chairman.
Please.
I feel like we'd be remiss if the panel didn't take advantage of your expertise in this field, since you've done audits in multiple states. Can you tell us the policy decisions regarding qualified and non-qualified expenses? How does Georgia relate to others? So do you see qualified expenses in other states that Georgia considers non-qualified that we should consider qualified? Or do you see any qualified expenses that we allow that other states don't, that you kind of sit there and shake your head about and wonder?
Sure. I think the big divide is between whether you allow above the line expenses, which is kind of unique to each film, cast and crew, producers, or just below the line, which is kind of standard cast and crew. That's the biggest distinction. States that allow above the line expenses like Georgia were very comparable to those states in terms of what's allowed or disallowed.
What states don't allow above the line?
Let's see. I can't come up with a definitive list, but
I guess the better way to ask is, do the majority allow above the line?
the states we compete with, like New York allows above the line, New Mexico allows above the line. The states that we compete with allow above the line. I would say we're comparable in terms of what we allow and disallow to those states.
I don't see any more questions, Peter, and I hope you'll forgive me for not attempting your last name.
Thank you, Speaker. I understand.
There, but thank you for being with us. Appreciate the presentation.
Thanks so much for the opportunity.
Yes,
Thank
sir.
you.
Next, we have Tony West from Americans for Prosperity. His presentation. There you are, Tony. Okay, thank you for being here.
Thank you. I've been standing outside. It's a packed room.
Can I make an announcement real quick? There is, and next door here, Building B, there is another room that has live stream. If anybody wants to, that doesn't have a seat, wants to go over there, it's available right across the way.
Yeah, it's good to be here today. I know I stand between everyone here and the break, so I can keep my comments brief and absolutely do my best to answer any questions you have. Like I said, thank you for the opportunity to speak today. I'm Tony West with Americans for Prosperity, Georgia. I'm going to use my comments just to kind of share our point of view on where we'd like to see the committee and the General Assembly overall move in terms of what to do with our tax credits and our tax code overall, and then close out with a policy proposal that I'm happy to dig into more detail after this committee concludes, but can at least briefly share one thing we're thinking about. So at AFP, we advocate for policies that will create an economy that works for all, empowering people to earn success and realize their potential. A simple, fair, and predictable tax code has the potential to unleash growth and innovation so that more Georgians have opportunities to pursue their version of the American dream. The first document that should be in your packets is just our principles for state tax policy. It's 5 broad principles we encourage lawmakers to consider with any conversations about our tax code, including tax credits. One principle we aim for that is most relevant to today's conversation is equitability. So lawmakers should eliminate all corporate welfare and special interest handouts that create a 2-tiered tax system. Tax policy should not pick winners and losers by providing favors to politically preferred behaviors, businesses, or industries. So as this committee is well aware, the amount of money in credits, exemptions, deductions that our state allows for annually significantly impacts the revenue our state collects. Our preferred approach for this committee to pursue is to see a significant reduction in special interest tax breaks so that the savings can be used for across-the-board reductions in our personal and corporate tax rates. I appreciate this committee's desire to take a fresh look at analyzing these mini credits. As this committee has already heard, the way it's been done in the past leaves a lot to be desired. But even the credit with the highest ROI is still money going to a politically preferred endeavor at the expense of the average Georgia taxpayer. The fairest and most geographically and socioeconomically diverse ROI possible is when taxpayers are able to keep more of their hard-earned money and they're free to spend it how they deem to be appropriate, not government officials. The lowest level of taxation possible while providing the necessary and effective government services we all want is a laudable goal, but this is also a matter of competitiveness for our state in relation to our neighbors. Even though we're on a track to lower our personal rate over time, we're still one of the highest in the Southeast, and our corporate rate is middling relative to our neighbors. In fact, last month, as many of you all know, North Carolina passed a bill to lower their personal rate to 2.49% by 2029, and they've been planning for a couple of years now to phase out their corporate rate altogether by about the end of this decade. And that's fairly important because, as we all agree, North Carolina is a competitor with ours in terms of quality business climate and attracting businesses to the state. Georgia should find ways to ensure our tax rates don't become relatively high compared to our neighbors, and eliminating corporate welfare and lowering tax rates for all corporations equally is a better way to attract businesses over the long term. Sunrise and sunset analyses of credits are important to ensure wasteful credits are never enacted and ineffective ones are removed from the books quickly. And that's when I do want to mention the second handout now, because we think this idea of a comprehensive unified budget is a way that the state can systematically control tax expenditures instead of losing control, if you will, or trying to do one-off attempts to gain control of these things. When we say a comprehensive budget, we mean that it's a budget that incorporates all spending and all revenue policies in the same budget document. Our annual budget is very transparent in terms of showing spending by revenue source. We do a good job there, but we don't include in the document all of the credits, deductions, exemptions, and exclusions that make our tax rates higher than they otherwise would be to finance appropriate government services. Putting it all together can help the General Assembly consider the trade-offs and how to shift resources to better uses. For example, funds for economic development projects and foregone revenue for certain tax credits might be better used to reduce our personal and corporate income tax rates, which would do more to support broad-based prosperity across the state. This idea isn't prescriptive in any way. A move to a fully comprehensive budget will just increase members' awareness and their ability to manage holistically our budget every year while they manage other numerous budget priorities. So with that said, happy to answer any general questions, and I would be happy to follow up with any additional information on how this committee or the Assembly could move forward trying to incorporate a unified budget.
Thanks for being here, Tony. And you were saying earlier, of course, we were talking before about above the line and below the line expenses, and it kind of is a parallel thought here. You're saying that a lot of this stuff is hidden. We get a budget that says, here's your revenue, but yet those, and I've got two appropriations chairman here that maybe can correct me, but it doesn't seem like those things are really listed as one of the things, when we look at where we're going to spend our money, that anything we do should be there and transparent in our annual budget process is kind of what you're saying, isn't it?
Yeah, that's right. I mean, those numbers are out there. Sometimes they can be harder to find than others, but incorporating them all in one document, because we know lawmakers are busy. We know the appropriations process is difficult. Putting them all in one document so we can actually show where our money's going, what we're choosing not to collect, and when these tough budget decisions are being made, it would be really beneficial to have that there.
You had a question? Well, I mean, just to point out, Tony, are you talking about something in addition to the expenditures report that is part of our budget in Georgia? I mean, I know it's preemptive, if you will. This is money that we didn't get to look at, but we list an expenditures report, tax expenditure report as part of the budget. Are you talking about something in addition to that?
I would like to see, at the bare minimum, in the appropriations bill, very, very upfront and on the front end. But ideally, in an ideal state, we're talking about having concurrent bills to make changes as necessary with these tax expenditures.
Okay, so you're talking about changing tax, but not listing them, because the listing is actually in the governor's budget from last year. I mean, it's obviously can't be predictive, but it's going from.
Sure.
But you're talking about to wrap into the appropriations bill changes to the expenditures.
Absolutely.
Fair enough. I just wanted.
Tony, if I could add to that, I think that it makes sense to do that. It's good for everybody to have good transparency. As we audit these and we get the actual return on investment, I think what should be put in there is, here's the amount of state tax dollars, here's the return on state tax dollars as well as local, so people can see the full picture. If we're going to do it, let's make sure we do it very methodically and accurately. I believe you would support that, correct?
Absolutely.
Thank you.
Anybody else? See any other questions? You got us back ahead of schedule. Thank you for being here, Tony.
Happy to.
Appreciate
Thank you.
that very much. If nobody has anything, we're going to take a quick 5-10 minute break, and then we'll get started back. I will have an announcement or two at that point, and see you back here in a minute. Thanks. their seats. Had a couple of announcements before we move into the next phase of our discussion this morning. We're running a little long and running this a little differently than we have some of our other meetings. So if there are some industry folks here with film that want to make a comment or two after we kind of break it for lunch at 12, we will have some time for that. We have some of that scheduled. If you'll get with either Diego or David or Alex and let them know that you have that desire, we're going to try to provide some time there. There's an awful lot of folks that wanted to speak, testify. And then we also have a very special invitation from one of our local film partners here.
Sure. Hey, I'm Joel Harbor with Athena Studios and just wanted to extend an invitation to everyone here. When we finish up today, you're welcome to come do a tour of the studio. We'd love to have you. We're going to take a look at the stages and also the UGA Learning Center that Dean Davis mentioned earlier. So we'd love to have you out, and it's 890 Athena Drive and just a couple miles from here. So look forward to seeing you there.
Thank you, Joel. I understand it's quite impressive. Look forward to that. And now we've got a study. I think we're going to be zoomed in here to discuss a study that's recently been commissioned and finished on the film incentive here in Georgia. Not really sure who I can turn this over to. Do I turn it over to Leon and
yes, please. Yeah,
Eleanor? Are y'all ready to go?
we are. Can you hear us okay in the room?
We can. We'll try to keep getting everybody to quiet down a little bit, and you'll get us started. Thanks for zooming in.
Thank you so much, and thank you all for the opportunity to speak to you today and to talk you through the research that we've been undertaking in Georgia for the last 6 months. My name is Leon Ford. I'm Managing Director of Olsberg SBI, and I'm joined by my colleagues Eleanor Jubb, who's our Associate Director and Economist, and Kaylee Hughes, who is a consultant with the firm and was the project director on this study, which is looking at the economic impact of the Georgia entertainment industry tax credit. Just to talk you through the contents of what we're going to talk about, we have 5 areas, and this is very much some headline findings, but I'll give you a quick overview of the study. We're going to talk about the growth in film and television production spend in Georgia and in construction investment as well. Then give you the results of the economic impact study that we've undertaken, and finally talk to you about the additionality of the credit as our research has found, and then end with some conclusions. So just to kick off with a quick word about us, Olsberg SBI, as you'll tell from the accent, is a company headquartered out of London, England, but working very much globally, including across the US, in this sector, in film, television, and digital media. We've been in business for over 30 years in this sector, and we work for governments, for trade associations, for other organizations and private companies across this sector, including in states like Illinois, New Mexico, Utah, and national countries from New Zealand and Australia to most parts of Europe and beyond. And most recently in the United Kingdom, we worked for the government's Revenues and Customs Department, looking at the UK's creative sector tax reliefs. So we're very much specialists in this sector and specialists in fiscal incentives. And we believe that the analysis of these mechanisms, of which we've seen a significant global growth, needs a sort of specialist, needs to be looked at through a specialist lens, if you like. There's, it's a very specific sector with its own specific investment drivers and investment flows. It's very much a globally connected industry. And as we'll talk about later, some of the jurisdictions that compete with Georgia for production dollars, are very much global. Although we're specialists, this is very much an independent piece of work. We believe that sort of independently looking at these systems is very much an important part of their management and to, ensuring that they're delivering return on investment for the jurisdiction they're operating in and for the funding of them. The study we're going to talk you through is very much a holistic look at the credit, and it may differ from some previous work you might have seen because of the industry data that we have for this study. We spent a long time gathering production data from investors in Georgia and also data from construction investors as well. And we've brought that data together with state data sources as well. And just before I hand over to Kaylee to talk about methodology, as I say, this is very much a headline findings presentation. The full report is over 120 pages long, I think. So you'll be receiving that later this month, and it has a lot more detail in all of these areas, including a very detailed methodology, which is very sort of transparent about the approaches we've made in undertaking this work and some of the assumptions and data sources too. But thanks again, and I'll hand over to Kaylee.
Thanks, Leon. Hi, everyone. So I just want to walk through part of the methodology, particularly around the data inputs that we had for this study. So as Leon mentioned, we had both industry and states inputs for this study, as well as data relating to both production expenditure, particularly incentivized production expenditure, as well as the studio construction investment. As part of this, we conducted a range of confidential consultations, over 36 consultations with members of Georgia's film and television industry, studio operators and owners in the state, as well as incoming producers, so from elsewhere in the US or international, who have produced in Georgia, and then also members of the Georgia legislature and other key stakeholders as well. And then to gather data, we hosted 2 surveys. One was for recipients of the tax credit to understand the effect of the tax credit in attracting them to Georgia, as well as what other factors may be involved there. And Eleanor will be walking through some of the findings of that survey later on. This was aimed at both decision makers in Georgia, as well as decision makers outside of Georgia, elsewhere in the US. And the survey captured, in terms of the number of respondents, around 82% of the expenditure that happened in Georgia between fiscal year 2018 and fiscal year 2022. And then we also ran a really detailed data survey and data document with studio owners and operators in Georgia. So this was to gather the really detailed, robust data on the investments they had made in studios, whether that was new developments, expansions, or renovations between fiscal year 2012 and 2022, as well as forecasted expenditure leading up to fiscal year 2027. And this survey captured about 96% of the construction investment that occurred over that 10-year period between fiscal year 2012 and 2020. And then we also had a number of quant data inputs for the study. So we had data that we received through GDEC, the Department of Revenue, as well as production companies and the studio developers and operators that we mentioned. And then this was all underpinned with extensive desk research. So on any other studies that have been done in Georgia, as well as any other reports or articles that pertain to the film and television sector, and an investigation and analysis of the broader environment that the industry sits within in the States. And then most importantly was the economic impact modeling that we did as part of the study. So we used the Implan software, which Eleanor will talk about as well in a little bit. But just to note for now that this is a modeling tool, economic modeling tool, that's been used and developed over the last 40 years. And it's widely used by local governments, business professionals, and academics. And it's used to analyze economic development policies and programs such as Georgia's tax credit. So I'm going to walk through the next section on the growth in production expenditure, as well as the growth of studio construction investment in Georgia over the last 10 years. So in terms of the production expenditure, as you can see, there's been a significant growth over the last 10 years since fiscal year 2012, which is the period that we analysed for this study between fiscal year 2012 and 2022. And I think it's worth noting that there's been a really unique growth story in Georgia. There has been an annual average rate of growth of over 17% between those 10 years, between 2012 and 2022. And the state has done something quite remarkable in building such a strong industry that is not only one of the leading production hubs in the US, but also globally. And just to highlight the heights of 4.39 billion in fiscal year 2022, and that while there is a bit of a dip in fiscal year 2023 to 4.1 billion, we think that's likely a reflection of the impact of the labour strikes from the writers and acting guilds this year. And in terms of construction investment, so this is non-incentivized activity. None of this investment is going through the tax credit, but is stimulated by the industry development that has occurred because of the tax credit. So through our analysis, we found that between fiscal year 2012 and 2022, 1.28 billion was spent on studio construction in the state. So that was new developments as well as expansions or renovations on existing studio sites. And then in terms of anticipated spend, so when we researched and spoke to investors, there's about 2.93 billion anticipated expenditure between fiscal year 2023 and fiscal year 2027 expected across Georgia. And I think this speaks really well to the investor confidence in Georgia's position as a stable film and television market in the US and globally, and also the future of the state as a production hub. So I'm going to pass across to my colleague Eleanor to speak about the economic impact work that we did.
Thank you, Kaylee, and hello, everyone. So I'm going to talk you through first about the model that we used to estimate economic impact. Great. So this is a visual that summarizes that method. So effectively, we've got a set of inputs on the left-hand side, and then a modeling approach, and then the results on the right-hand side. So in terms of inputs, we use lots of different sources of data, including production data from people from GDEC, from production companies. We modeled the incentive estimates, so estimates of the tax credits issued. We also input into the model studio construction data that we obtained from investors in studios. We combine this with economic data, so from federal sources such as the Bureau of Labor Statistics, and also the Bureau of Economic Analysis. And then we also input into the model an assessment of additionality. So this came from the surveys that Kaylee mentioned earlier, and it's really exploring how much activity would have happened in Georgia in the absence of the incentive. So we put those data inputs into the in-plan model. So as Kaylee mentioned, the in-plan model is a very well-established model. What we were able to do is, using some of the specific production data that we were able to obtain, we were able to tweak the model within in-plan to make it more relevant to this specific activity, so film and TV production activity. We ran the numbers through the model, and in terms of results, we get a number of different indicators from in-plan. So the first one is output. This is a measure of activity. It's the measure of the results of an economic process that's available for sale or use elsewhere. It gives gross value added, which is GVA, or value added. And this is a measure of the value created by an economic activity. And effectively, it's the difference between the gross output and the intermediary input, so what you put into a process compared to what you get out. At a national level, this aligns with the concept of GDP, gross domestic product, and it's roughly equivalent to profit and wages. So you can see that that's a value of economic of activity. We looked at jobs as well. So Implans are able to estimate jobs. So these are annualized jobs. So a contract that lasts 3 months would count as a quarter of a job. It includes those who are self-employed, and it can be part-time or full-time. Then we also estimated labour income, and this is the value of wages paid to people from as a result of the economic activity, and this includes the benefits that people get in terms of non-wage benefits such as healthcare. Implan also gives a result for taxes, so this is both state, local, and federal taxes, and from this we were able to calculate a GVA return on investment. So a GVA return on investment effectively, and we'll go into this in a little bit more detail, it compares the net cost to the state, which is the foregone tax revenue, minus the value of state and local taxes received, compares this to the GVA results. So that's a real measure of how much economic value you're getting for $1 invested. And each of these results in Implan, we get different effects. So we get the direct, indirect, induced effects. The next slide shows this in a bit more detail. So in terms of the direct effects, these are the impact on companies directly working on production. The indirect effects are the effects on companies supplying the production. And induced effects are caused by the cast and crew and those working in the supply chain spending their wages in the economy locally. So altogether, this is sometimes called the halo effect. So that's the three areas together. So an example of this might be, so an indirect effect of the supply chain effect could be a local lumber yard that the production team purchases lumber for the construction of their set. An induced effect might be a crew member purchasing lumber from the same lumber yard, but to use for their own project at home, for example, building some decking outside their house. So I hope that provides enough of background in terms of what it is that we're measuring in this study. Next, for the results. So at the end of this process, we looked at the impact of the Georgia Entertainment Industry Tax Credit for fiscal year 2022. And as you can see, overall, the tax credit has had a significant economic impact. In terms of gross value added, the overall effect is around $5.5 billion in terms of GVA, with over $3 billion in direct GVA. Economic output, the total economic output generated by the tax credit is $8.5 billion. And in terms of the direct economic output, that's around $4.5 billion. Labour income, also a significant impact. So in total, the total effect is around $3.5 billion in fiscal year 2022. And the direct impact of that, the direct component of that is around $2.2 billion. So as you can see, in one specific year, really significant impact. Now on to jobs. So this is for 2022. And I should say that this analysis combines both the production impact and also the non-incentivized construction impact that we saw through our research. So in terms of jobs, we know that jobs in the screen production sector are well paid. So in terms of the average for the motion picture and sound recording activities nationally in the United States, it's around the average annual wage is around $86,000. And that's across lots of different occupation types. And that can be compared to the average wage in Georgia currently of around $58,000. So you can see that there's a significant difference there. They're highly skilled, and I think you'll hear later about the skills that have been, the skill development programs that have been happening in Georgia around this. But it's a highly skilled, includes highly skilled occupation. And also we found, and there's evidence to suggest that it's less susceptible to automation in terms of jobs for the future. It's creative and less less susceptible to some of those forces at play in the economy. So in terms of jobs in Georgia, the tax credit in fiscal year 2020, when you combine the direct, indirect, and induced effects, we estimate contributes around 59,700 jobs into the Georgia state economy. This is made up of 34,600 direct jobs, and then further jobs in the supply chain and in the induced effects as well. We also looked at the last 5 years and totaled the economic impact over the last 5 years. And you can see from this slide that the total value added created by the tax credit in those years, in those last 5 years, is nearly $20 billion, of which around $11 billion are the direct effect. In terms of economic output, the picture is closer to $30 billion in the last 5 years, with around half of that coming from the direct effect. Labour income, similarly a significant contribution, $12 billion for the last 5 years in terms of total impact, and around 7.6 billion in terms of the direct effect. So in terms of this, the return on investment. So the way that we measure return on investment connects directly with the intention of the programme, of it being about attracting inward investment, attracting this type of production, and its economic development aims. So the way we calculate it is it's a measure of $1 of investment, how much economic value is created per $1 of investment. So the cost to the state is estimated at the total value of the tax credits minus the additional state and local taxes received. And this is compared then to the GVA. So across the whole study period, so this is the 10 years from fiscal year 12 to 22, the overall economic return on investment is 6.1. So this means that for every $1 net investment in the tax credit leads to an overall uplift in GVA in the state economy of $6.3. You'll see from here that there's we've separated that into the direct effect, the indirect, and the induced, and those are summed together to get the 6.3 figure. This cost to the state, which is the foregone tax revenues, are received 1 or more years after the production has happened. And Peter mentioned this earlier, that effectively a delay in the payment of or the foregone revenue effectively makes the financial position of the state more attractive. It effectively reduces the value of the credits due to time preference and inflation. I'm going to move on to the next section, and very well happy to answer questions on all of this at the end. So we're going to look now at our evidence around additionality. So this is sometimes called the but-for argument, and it's really about understanding what would happen in the state without the tax credit. So we sent a survey to producers and to investors in studios, and Kaylee mentioned we had a good response rate from both of those groups. And the production survey that we undertook covered approximately 82 of expenditure in Georgia between fiscal year 18 and 22. So we think it's a very good reflection of what's happening in the industry. So first of all, we asked respondents to rank the decision factors about what brought them to, or what caused them to shoot in Georgia. And as you can see from the chart, the most important factor for both those based in Georgia and also those based elsewhere in the United States, was the tax credit. Second was the facilities and infrastructure. Overall, there isn't much difference actually in terms of those the factors in terms of where a producer is based. It doesn't really influence their ranking very much. One of the next questions we asked, so we asked that question first to ensure that there wasn't any anchoring around people focusing on the tax incentive, the tax credit specifically. But then we went on to ask production companies to estimate to the nearest 10% the proportion of their project that would have been made in Georgia in the absence of the tax credit. When we weighted the results based on the scale of expenditure in Georgia, the result gave us the insight that 92.1% of expenditure would not have gone ahead without the tax credit. This is really a very important finding. So we can be confident that a lot of the expenditure that's happening in Georgia currently would just not have happened if the tax credit was not there. We should also mention that this is not a unique finding to Georgia, that this kind of is corroborated by other evidence from other jurisdictions, just about the importance of credits for attracting production. In terms of the studio construction, so Kaylee showed you earlier just the how much studio construction activities happened and how much is planned for the coming years. So what we found is that this studio construction activity is highly dependent on the tax credit system. So our survey covered about 96% of construction activity between 2012 and 22, and 94% of respondents asserted that their investment would not have happened or would have moved elsewhere without the Georgia tax credit. And actually, when we weight that based on the scale of investment, it's very close to 100% would not have happened. So that last 6% actually doesn't account for very much in terms of production construction expenditure. A similar pattern is found for future planned investment. So the survey indicated that all of the planned construction expenditure is very dependent on the tax credit. I'm going to pass back over to Leon just to conclude.
Thanks, Eleanor. Yeah, and just a final few thoughts on in terms of conclusions. I think as Eleanor's explained, we found that the tax credit in Georgia was creating significant impact across both incentivized production and non-incentivized construction. We did some modeling in the study around how that spend moves around the economy in Georgia and looked at the type of jobs that it was creating. And as Kaylee says, screen productions require a large amount of inputs in terms of different types of jobs, different types of supply chain. It's very much a type of advanced manufacturing activity. So there's lots of impacts in terms of the jobs it's driving. I think as we said, when looking at the expenditure growth, Georgia's been really successful in developing an industry ecosystem that has really driven growth very markedly, particularly in an era of increasing competition for production. Currently, there are around 117 such incentives, both at a global level, including about 37 US states. And really for Georgia, the credit is a cornerstone piece for the growth in state, but worth also noting the talent in state, the infrastructure, and I think what's well recognized as a gold standard training offer. Georgia's been very successful at rapidly developing its industry training through the Georgia Film Academy and other providers. And I think just underlining the fact Georgia has done this when other jurisdictions are also competing with it and looking to get those production dollars. So that concludes the presentation. Thank you very much for your attention. We're happy to answer any questions, and our our emails are on screen if anybody would like to follow up with us separately. Thank you.
Okay, thank you all for the presentation. I know we've got at least a couple of members with some questions, but let me ask a few up front. And we're very familiar with M-Plan. Our fiscal audits department here uses it. We put indirect, we put indirect, induced. So maybe we're more familiar, with this than maybe some groups would be.
Right.
Our multiplier was 1.84. I guess maybe you've got some slides that aren't here. I didn't see it. It looks to me like about a 1.89, which would be reasonable. Is what was the multiplier you used for this in the M-Plan model?
Yes, that's right. So as you know that the multipliers are kind of implicit in M-Plan, and it does work out with the output multiplier to be about 1.89, and the GVA multiplier and the jobs multiplier is slightly different. And it's so the GVA multiplier is 1.71.
Okay, and then in the first slide, I think you did, Eleanor, which was slide 9, you talked about state and local tax revenue, but there was no fiscal ROI in the report. We always have a fiscal ROI, and it's talked about in the beginning, but at the end, when you talk about the results, I don't see anything there on that.
Yeah, that's right. So we tend not to calculate fiscal ROI, really because of the overall aims of the program are aligned more to an economic judgment in terms of that being the return on investment that we tend to use in this situation. Don't know whether Leon, you want to come in on that point.
No, just to agree with that. I think we feel it can be a misleading metric given these generally are set up as economic development tools rather than sort of fiscal or tax generation tools.
Well, it's important to us if we're going to say what's going to be impact on our state revenue when we do something. It's certainly important to us, and the fiscal audit department here does a pretty good job with it. And these historically come back pretty low compared to a lot of the other tax credits that are out there. Now you used, trying to remember the number, was it 92.1 you said because of not everything being there was the number you were using? I didn't see that in the final calculation. If you use 92.1, it looks like the 100% was used again down there.
So that 92.1 has been applied to the production expenditure before it went into M-Plan, and then the construction expenditure, that was the 100%.
Mm-hmm. And
so, but the results have been combined for the purposes of this presentation.
Okay, and when we do, surveys, I guess I would give an example. It doesn't really come to us, but in the metro area, we have developers that have bought property, they broke ground, but then they're saying, well, we wouldn't build it unless we get the tax credit. And it seems like that might not be necessarily the most accurate way of finding out the but for. And I was looking at a separate Georgia State report here, and it looks like Florida on their report with their numbers, now they're a little bit more inflated than your numbers, but I'm comparing apples to apples because Georgia was there higher too. But basically Florida looked like they were about 70% of Georgia with no tax incentive. North Carolina was a little over half with a cap of 31 million. Virginia was a little over half with, trying to remember what their cap is. I want to say it's like 11 million. So, I have a hard time saying, here's somebody that's got a fraction of it that's doing over half or 2/3 of the stuff, but yet almost 100% of it is due to this tax credit. It just doesn't seem to, it seems like that should be considered in these studies. What happens in other states when there's no tax credit there, when there's a minimal? No doubt it has brought jobs to Georgia. No doubt it's been a boon to get companies come here, but it's just the percentages. I don't know that I'm comfortable with a survey of people saying, what would you do if it wasn't here or not, I guess is what I'm saying.
Yeah, and we do try and minimize that respondent bias. We don't go straight in asking about the tax credit. The survey questions are quite carefully structured not to lead not to lead any respondents, we tend to offer the answers alphabetically, for example, and things like that. But I think with the comparable jurisdictions you mentioned, I'm not familiar with the numbers, but that you mentioned, but we can certainly take a look at those offline and come back to you. But I think in terms of industry size, if that's what you were referring to, I think Peter from Bennett Thrasher mentioned this earlier. I think in terms of the jurisdictions that Georgia competes with, they, thinking of New York or British Columbia or the UK, which get very high levels of production, they offer very similar sort of incentive packages rather than somewhere like Florida, which doesn't offer an incentive package at state level.
All right, then the last thing I'll say is, there's the but for there, which I think we should look at other states, but also the instead of. I don't think there's anything in here, if this money was used elsewhere, what would happen? That's how our fiscal audit tries to get a net amount by saying, if this money was used elsewhere, what's the average return on it, to come up with what this is actually doing for the state.
Yeah, it's a great question. I think for this study, it's not something we modeled in terms of how, in terms of how spend could be redeployed in other ways. I think, our view would be that it as an economic development tool, it should be sort of compared with other economic development tools. But I don't know, Eleanor, if you have anything to add to that.
All right, thanks for your answer.
Thank you.
Thank you. I had a couple of questions. We're getting serenaded here. I don't know if you guys can pick it up over Zoom, but we got a phone in the background.
Okay.
A couple of questions about the numbers. I'm a numbers guy, as are a number of people here on the panel. So I'm looking on one of the slides. You had a total of 59,700 jobs that were direct, indirect, or induced, right? I mean, that's I'm reading that correctly. And I know there's other things, and this is a gross simplification of it. But just doing the quick math, back of envelope math on that, 60,000 jobs at an average of 80,000 at 5.75% income tax generates $276 million. We're spending $1.3 billion to get that. What am I mean, I know there are, and again, I know there are other things local, but just from an income tax, am I missing anything with those numbers, Eleanor?
Sorry, I just so I'm following your maths. So you're saying the jobs multiplied by the average wages, and that gives the total in terms of the amount of the kind of effectively labor income. Is that what you're you're trying to calculate?
Exactly. That's the gross income. That's not even assuming there are going to be deductions, which would lower that amount, but that's the gross income tax. Am I hearing your numbers right? You said $80,000 for an average job. You actually said that was in the business. I'm applying that to induced jobs. So I'm applying that to somebody working at McDonald's, which I think actually moves it up, maybe a little higher. I'm just trying to see if those are am I correct in ingesting your numbers correctly?
Yeah, so I mean, my preference would be for you to use the labor income figures to calculate the labor income, because effectively then that utilizes the right average wages for each of those sectors. Because obviously, as you mentioned,
fair enough. Fair enough. And again, that's where I was going next, because you said induced impact is $2.61 billion, and maybe my math's wrong here, but I divided that by 15,300 jobs, which is the number of jobs you had, and I came up with an average wage of 174,000. Am I
okay?
Am I a digit off there?
I think I'd have to look at that a bit offline in terms of those calculations. I mean, I think, yeah, there is implicit average wages in InPlan, and because of the data years that we've had to use in InPlan, there's a slight differential from the number that I quoted at the outset. But it sounds to me like there might be something off with the calculation.
Well, if you divide 2.6 billion by 15,000, you get roughly 174,000. And so that was where I was going to try to get back. I don't question, we value the industry. You know, we're talking about the tax credit. Nobody's targeted per se, but when I get numbers like this that I look down and go, how could that be? I would need some clarification on how 15,000 people make $2.6 billion in the induced. I mean, somebody must be coaching football someplace.
I could definitely look out the average wages for that part of the calculation if that's helpful, and we can revert on that.
That would be great in the direct and indirect and induced. Thanks.
Yeah.
Thank you. Just following up, you've got a bunch of math people here, so it would be helpful if you could provide the more detailed analysis and the numbers behind that. That might help to either further prompt questions or maybe clear up some confusion. A couple other quick questions. You make sure I understand. You surveyed the folks who are doing films in Georgia today. Is that the sole source of your analysis?
For the survey aspect, for the additionality aspect, yes. So there was other data used for other aspects of the study.
Okay, and we were talking about different areas. In fact, we talked about British Columbia, New York, California, London, etc. Did we do any analysis of, again, the differences of what's happening there based on what's self-reported here? This is a little bit siloed right now, and again, you're a bunch of data junkies here on this committee, right? So we're looking for the bigger picture. What other outside influence analysis to look for? Because to me, that's what the but-for argument is really about. Right? Because if the but-for means you have other options and you can go to different places, how do we look at how some of the other competitors did?
Yeah, and that's definitely something we're very close to as a company. As I mentioned at the start, we do a lot of this type of analysis in different jurisdictions. So thinking of the UK, for example, where we're based, the spend last year was over £6 billion, around $7 billion. And I think as I say, this is an industry that has grown in terms of content investment in the last 10 years. And just as Georgia has increased, we've also seen key markets that are able to offer incentives and infrastructure and a crew base have also been developing as well. So I think in terms of competitive position, there are other major markets around the world. Thinking of, you mentioned British Columbia, the UK, Ontario in Canada, and those are all markets that have grown very quickly as well as Georgia. And I think the drivers are very much, we're in a period of very high cost inflation for productions. And as we mentioned earlier, this is a sector that is very sensitive to these sort of incentive models. They help guide where productions are sited around the world. And, some of these shows can have very, very high budgets and carry with them a lot of financial risk for the investors. So finding somewhere like Georgia that has a very stable and good business environment and a very stable incentive, as well as the infrastructure we've talked about and the sort of crew base makes it a very competitive state.
And one final question. When you look at the analysis, especially getting back to the but-for, there's, let's say someone moved and invested in the community 7 or 8 years ago. They have built infrastructure, they have built talent, they've got everything there. Their but-for answer would obviously have swayed differently than the person who's thinking about relocating here and moving here for the first time. Did you take that into account during your analysis?
That's a really interesting question. We didn't model that specifically. And I think, I guess what the results of our survey, it does incorporate those people potentially who've decided quite recently to move or have production in Georgia, and also those people who probably made that decision quite a long time ago. I think the results of the survey are really clear that actually the tax credit does play a very important role in that decision making across the board. Really, there are very few responses who say that it doesn't matter. So I think in terms of the analysis that we've done, it perhaps suggests that it may actually still be quite a similar result, even within those two two groups. And I think that this is underlined by evidence that we know from other markets that production is very mobile. It's a very mobile, globally connected industry.
Thank you for your answer. I'm sure everyone you spoke to agreed that the tax credit was critical to their business. That's probably not a surprise to anybody, but I do believe that we're going to be intellectually honest in the way we're approaching stuff. We have to separate out those who we've attracted, who are here and already have the infrastructure in place, versus those who are trying to come in. And that's the way we would do most any other economic development projects for the state. It's a different way of looking at things clearly, but I think it makes a lot more sense for us to understand the short, medium, and long-term impact. Thank you.
We get Chairman Tillery, you want to?
Let Doc go first.
He is deferring to you, Chairman Tillery.
Thank you for your report. I have a question. I'm Blake. Our understanding is a lot of these credits aren't necessarily used by the film companies themselves, that they're turned over, sold, or transferred. Does your report take into account any of the transaction costs associated with that transfer to figure out what the actual impact to the company is? I've heard some anecdotal evidence. People tell me, it's 88 cents on a dollar or something like that, but I've just not seen that. Do y'all have anything that shows that? And how does it impact your analysis?
So we heard a similar figure to you around that from our consultation process. It's not something that we've modelled specifically because our focus has been on the cost, or the cost to state in terms of foregone tax revenues, and then the impact of the production or non-incentivized construction activity. Obviously, that tax benefit that's seen elsewhere in the economy would have an effect as well, but we haven't been able to access data that gives us a clear picture of that across the board, enough to be able to model it.
Oh, Senator Redd, I was just going to say, we have quite a few number of people here, which I can appreciate. As a matter of fact, the old Representative Buckner here, a half a penny. I'm still trying to figure out how to pay her on that. But I noticed when you're talking about industry growth, that between 2012 and 22, FY22, that about over $1 billion was spent on studio construction in the state, which shows investor confidence in Georgia is strong to pay that cost out of pocket. But you combine that with the multiplier effect, that can have quite an economic boom on not only just metro Georgia, but also rural Georgia. Just a comment. If you have any thoughts, you can expand on that.
Yeah, I think we definitely agree. It's, as Anna says, we spent a lot of time in consultations sort of digging into how investors felt about the state, and certainly the confidence that Georgia was being able to build and attract so much film and television production was a very key factor in those investors sort of coming to build in the state.
Well, I think we're going to wrap it up there. I did have a couple of thoughts. I know y'all unpacked this thing and threw the presentation together kind of, right on the heels of it being completed. So I know there's going to be some other things to discover, and maybe some other questions that come up. A couple of things that might be helpful based on some of the questions that I heard being asked maybe were that if you have, other industries based, on similar incentives, what would their growth look like over the same period, and impact look like? I guess the other thing would be for Georgia specifically, and having grown up here, I could only anecdotally talk about it, but how many productions, how much was going on prior to this particular change regarding the incentive. So thank you very much for your input. Appreciate your time and zooming over at what I'm sure is a interesting hour in London.
Thank you very much.
All right, thank you again.
Thanks.
Moving on, we have panel set up, and
I believe Frank Patterson is here, the president of Trilla Studios. I know he is. I saw him earlier. While he's making his way up to introduce our panelists, I did see one of our local representatives, Marcus Wiedauer, joined us. Marcus, thank you for being here. Did I miss anybody else? Or? Thank you.
Thank you, Mr. Chairman.
Mr. Patterson, the floor is yours and your panelists. We look forward to the discussion.
Thank you, Mr. Chairman, and thank you, fellow assembly members. I have the honor of introducing three panelists, colleagues, all of whom are representatives or kind of a sampling of the ecosystem of support here in the state of Georgia. And all have different stories and represent a different part of that ecosystem. I think we all know what some of that outcomes of that study said, which is what are the reasons why these productions come to the state of Georgia, right? The tax incentive. The second was the infrastructure and the facilities. And of course, the third was the crew. And this group here is part of that ecosystem for that number two. What I thought I'd do is I'm going to let, and by the way, by way of introduction, Bhugesh Patel, who's the CEO of BI Production Works. It's amazing sort of Georgia boy made good story, taking two trucks and putting them into a multi-million-dollar business. He'll tell you more about that. And then Kate McCardle, who an executive for 20-something years in the movie business, decided to commit all of her knowledge and resources into education. She serves as the director of film workforce at the Georgia Film Academy. And then Missy Martin, who is the president of Cherokee Office of Economic Development, has some really interesting insight into the impact on community. So you're kind of getting a across the board look at the infrastructure of the state of Georgia, and this is just a sample. And then what I thought I'd do is we'll each just take a couple of minutes and describe what it is we do, how it is that we've grown into success, and how we look at the future. And by the way, I'm Frank Patterson. I'm the CEO of Trilla Studios in Fayetteville. And I'll kick it off by saying that we now have 32 stages and more than 1.5 million square feet under roof at Trilla Studios. But Trilla Studios is just a part of Trillith. Trillith is this place, by show of hands, who's been there? Oh, wow, okay, that's great. It's a place, we think of it as place making more than we do studios. It's a place that the vision is to have every resource that storytellers need to do anything they can imagine, right? And so in looking at those numbers that the Oldsberg team put together, it's not representing all the sort of investment dollars we've put into the dirt because we're including a town. So Trillith has a studio with stages and 1.5 million square feet under roof. We have a town where about 1,100 people live right now. It's being built and designed for about 5,000 people. We have retail and education. In fact, we have 65 businesses at Trillith that represent over 1,000 FTEs. And this is all, of course, centered around storytelling, around the film industry. And I can tell you very emphatically, those dollars would not be invested, having personally raised and invested hundreds of millions of dollars in Trillith. They would not have been invested without the tax credit. It's the confidence that I'll tell you that investors need and that comes with a tax credit, and really the reputation that the state of Georgia has and has had for being a state that is very good to businesses, into the business environment. And so I can tell you that our investors saw that stability as critical to making what's over $1 billion of investment in the dirt just at Trillith right now, with a planned another $700 million, $300 million already underway. So as one who represents investors, I'll tell you that confidence comes from this policy environment and the long history of Georgia being a great place to do business. It also comes with knowledge that our productions, the productions that are that make up our business, feel confident in those three requirements: a great tax credit, infrastructure with businesses that really know what they're doing, and then an incredibly well-trained crew base that is key to the reliable outcome for these productions. Having been in other states, full self-disclosure here, I served on committees for 2 governors in the state of Georgia. I'm sorry, the state of Florida. having watched why productions come and how incentives work, because a state tax passes a state incentive or a tax incentive in the film industry, it does not mean that state is going to be successful. I'm sure Peter and Stephen and others here can give the list of states that have failed in the film industry, believing that the tax credit was the reason why it happened. It just doesn't. If private capital doesn't come to the table behind it, and that private capital has to feel confident in the policy environment, then it won't work. And if the crew is not reliable, productions consider the expense too great and not worth the benefit that they get from the credit to fly in the crew and to build the infrastructure necessary for their productions. So we at Trilith, what we feel like we've done is put this $1 billion+ into the dirt to create a stable, reliable environment that productions can trust. And we are, sister organizations to a lot of facilities around the state that are doing the same thing. So just a note about, I'm going to ask each of us to talk about what we do and why we're successful, and a little bit about, oh, and by the way, I can't name my favorite movie without naming something from Trilith, because if I name something other than what something shot at Trilith, so probably Avengers Endgame. Okay. I'll tell you the real movie in a minute, later, offline. When we think about the future and future growth of Trilith, I'm going to speak for Trilith. By the way, Trilith, meaning 3 pillars. We're investing in facilities, we're investing in technology, and we're investing in content. By the way, my auditor is in the audience here, so I have to be very careful. Peter, okay. The facilities business is easy to understand. And this survey data and everything that was talking about the value of this credit, that's great. And that's why we're the #3 state in the nation in terms of value from the film industry. However, a lot of value is being left on the table. And we at Trilith feel like that value resides in the IP associated with content and the technology necessary to exploit that content. So we're a close third in the United States as a marketplace when it comes to the value from facilities and infrastructure. We are a distant third, significantly distant when you consider the value of that IP. And what I mean is, by comparison, if it's $9 billion worth of value in the state of Georgia compared to New York's $14 billion of value from the facilities and infrastructure, it's 72 or $3 billion for New York in terms of value, including the IP. So we're distant third. We think making investments in content companies and content creators in the state of Georgia is how we're going to capture the future value of this industry. And I would argue that's not being measured in these studies because it's not relevant right now. But for my investors, in the way we see the future, it's critical for the growth and the value of our company. Georgia has a lot of bright, talented content creators in this marketplace that we haven't been exploiting as an industry. And that's where we're investing dollars in the future. And that's where we see all the growth happening. Now, Bhagesh, if you don't mind, telling us a little bit about how you went from 2 trucks to really a company that we rely on in the film industry for transportation and equipment rental every day.
Definitely. Good afternoon, everyone. My name is Bhagesh Patel. I also go by Ben Patel. Many of you know me by that name. My favorite movie is Fifth Element, Bruce Willis. It was, when I was a little kid, and I've always seen that if you can think of it, it's possible. And I think the world today shows you that what we thought about 20 years ago was not possible. It's definitely possible today. And on top of that, especially United States of America. So I was born in India, moved to United States when I was 7 years old. Actually moved to Kennesaw and then slowly migrated to Madison right in the year the Olympics were here. So I remember small town, I was the only Indian kid in town. So everybody thought I was Puerto Rican because they didn't realize there was a continent that was India and you could be brown outside of that. So it was great. I took whatever it was, one thing that I learned in a small town is personality means everything. Relationship means everything, right? Yes, sir, no, sir. Yes, ma'am, no, ma'am. Respect goes a long way in the southern states as that we live in. So I built that in myself, especially going through schools and high school, obviously. There was one important lesson that I learned in high school was, you know what? The world that we live in, you got to get along with everybody, right? If it's white, blue, black, green, whatever it is, to be successful. And obviously, not being to India since I moved here at since I was 7-year-old, I migrated back to India when I was 18 after high school. And I realized at that point, when my dad left India, that there was an opportunity that he was seeking. And that was the reason that he migrated to America. And if I was there and my dad never came here, we would have had probably 1 acre of land growing sugarcane, and that was my future. So when I'm sitting there, I'm like, wow, I'm in America, and all I have done is try to get as many girlfriends as I can, have all the fun that I can, and never dream or have a future. So at the age of 18, I don't know what kicked in, spiritual, religion. I did a complete 180 and realized that I have to dream. And as soon as I came back to America, after being in India for a month and a half, I bought a dry cleaning operation at the age of 18, or 19 at this point, in Madison, Georgia. And I've had some experience in dry cleaning throughout high school, working as a high school job. So I went to Mr. Pascal that did movies in Georgia for Hollywood in the 80s, 90s, even 70s, when Georgia was all about just Georgia, pine trees, Southern film shooting. So it wasn't the tax incentive, but it was 1 movie out of the year, 2 movies out of the year. And Mr. Pascal, which I think is the smartest guy in the world, he's my Albert Einstein. He's still living, 84 years old, my mentor. And he said it's movie from heaven. And I was like, what do you mean? So I never paid any attention to that while I was working for him. And when I got out of high school and turned my life around and I'm dreaming, so I'm like, Mr. Pascal, can you tell me what that movie from heaven, the money from heaven means? And right at that time, I bought a business in 2006, a dry cleaning operation for $100,000, borrowed $50,000 in credit card debt, where you got these checks in the mail, and I filled out every one of those checks, cashed them in the bank account. Then I realized, oh shit, it's 30% interest rate. Well, that wasn't, and it wasn't bad, right? Because at that point, I was probably at the most bottom part of my life for me and my family. Couldn't afford school. I didn't want my mom to continue to clean rooms at a hotel. And my future wasn't to pursue high school or pursue education. So I can't go any lower than where I'm at. So if that means I got to debt everything out, we'll do it. First show, We Are Marshall. Thanks to everybody that's here and even people that were here before you guys. We literally cleaned football jerseys night and day at a coin laundry, and we made over $200,000 to pay off the high interest debt that we had.
Yes.
Yeah. And I literally at that point saw that if you really work hard, and I believe in this powerful energy, I believe in God, that if you put your effort and your mind to it, it's possible. So I don't have the privilege, as Trilith does, of having a $300 private investment money. So that's okay. I'll go with my 30% debt to start a business. Slowly after that, I married my wife from Paris, France. She came to Madison as an exchange student. I met her during there. Matt is laughing because Matt knows my whole story. And I promised her, I was like, you marry me, I will make Madison, Paris, France for you. You got to marry me, move here. And if you ever have a chance to come by BI Production Work, you will really see it is a true art of business. Again, thanks to the film industry that we're in. 2015, fast forward, we want to have kids. My wife's like, well, you got to be home to have kids. And what she means by that is in the dry cleaning operation, we had a retail business that was from 6 o'clock in the morning till 6 in the afternoon. Well, right after 7 o'clock, filming, stopped shooting, and then we're picking up clothes at night, bringing them back, cleaning them, and we have 8 hours turnaround. So before 4 to 5 a.m., the clothes are back on. So we're actually working 20 hours a day. Whatever it took, obviously keep the retail going. And the movie from heaven means it's the off hours that you're working that is not costing you as much as money as retail operation is. So in 2015, Athens is one of my milestone. Athens Mercedes dealership. We were doing Hunger Games, and thank God that North Carolina lost their tax incentive, and Hunger Games ran right out of North Carolina, came to Georgia, and we were cleaning so much clothes we needed a van. Well, when I was buying a cargo van for the cleaners, I saw these passenger vans. And that brought me an idea. Well, okay, my wife wants me to be at home. Maybe it's an easier job. All I have to do is buy vans and rent the vans to production, because I can fool anybody if I have the right product. So now I'm gonna take, where they're using a Ford, I'm gonna take a Mercedes and I'm gonna sell my story on a Mercedes van that is better than Ford. Obviously, I didn't know anything about vans or anything about transportation, but I knew my relationship ability, and what the film business wants is service, right? And it's dependability and how can you deliver. So I borrowed a van from Athens Mercedes dealership, took it to Game of Silence, which Neil was my first transportation coordinator. Again, this is a very close niche business. So I needed an intro. So my favorite costume supervisor, Leslie, said, Ben, follow my lead. And again, I'm married, have a ring on my hand. I don't have it on today. She's like, hey, Neil, meet my boyfriend, Ben. I need you to rent vans from him. So that started my story. Because of that comment from Leslie, Neil said, okay, I'll rent vans from you. At that point, guys, I had a price, and nobody ever takes us back to any production, but my price was $400 per week on a van. Well, I didn't say anything. Neil was like, I'll give you $585. Done. So I left there, bought vans. Fast forward the story. Today, we started with one van, not trucks, vans. 2 vans actually, and bought those. And since then, to 500 pieces of equipment, we bought vehicles because our customer wanted that, because they can get that from California, New York, or even Georgia. And what I learned in this business is that you have to listen, right? And I think that's where we're here today, right? We're listening to demands. Does all of it make sense? No, they want the world, but they want the stars, but let's give them the moon, right? So I go to these departments and I listen to what they want. And being able to do that, it keeps you humble. It allows people to help you, right? Anytime you go to a room where you're not the smartest guy and you listen to people, it helps you build a business. Today, after hard work of 100 people in our company that are all in Morgan County, that have moved from other towns, Edenton, Putnam County, Edenton, Greensboro, all these other towns, we're the largest employer in Morgan County as small business. We're the largest taxpayer in Morgan County. And yes, it is big enough. We have a Lowe's and Walmart and Chick-fil-A, obviously. So I'm not, we're not trying to beat a small company. But what this incentive has done for me is it has made my American dream possible. It's okay to dream. And I think everybody in the world dream, but those dreams are not possible everywhere else. And if I look back today, and if I wasn't in this country, if I wasn't in this state, would my dream been possible? If the votes and understanding what the film business has done, this is a Hollywood story. One day this will be a story of mine, because I feel like we are losing the touch of the American dream. And I sit here today as a prime example of, if you want it possible, you got to be in this country. And I take that very strongly, discipline oriented. It kills me to see why people don't try when they're in this country. The worst day of anybody's life here is the best day in countries that I've been. My thing, one thing that reminds me this every year, and what drives me on a day-to-day basis, is a trip to India every year to make me realize that, hey, this is where you would have been at. And right from January, December, you get into this world of Western culture, and it brings me back down to earth. And I start back over in January, and that's my fresh start every year. And I think that's very important for us to understand what this has brought to Madison, what this has brought to Georgia, and what it does for people like me that cannot get the investor, that don't have the right to dream in other countries and come here and make it possible.
Thanks, Mukesh. You are underscoring what a very well-known producer, who we won't name, who you and I both know, said just recently to me. There's nothing compares to the work ethic of Southern culture, the crew in the Southern culture. And it's interesting. Your work ethic is really laudable. Thanks for that story. And what you've done in your county, and it reminds me of what Kate and the workforce development team there at the Georgia Film Academy has been doing really across the state, and thinking about what our next workforce is going to be and how we can leverage rural Georgia, the real untapped talent in this industry. And the Georgia Film Academy has been really successful spreading itself across the state. And can you talk a little bit about that for us?
Yes, thank you. And thank you for your story. It's so inspiring. And speaking of two things that you talked about, one is opportunity for people in far-flung places that wouldn't ordinarily have had an opportunity. And I think that was one of the reasons that the Georgia Film Academy was created to begin with, because in 2015, the former governor said, wait a minute, exponential growth in the productions coming to Georgia because of the tax incentive, but not nearly enough Georgians being trained in the below-the-line crafts that will allow them to be employed in this industry. We need to solve that problem. The former governor, Nathan Deal, set aside an appropriation to create the Georgia Film Academy. He hired the first executive director, who's my former boss, Jeff Stepikoff, sitting over there. And we were tasked with creating curriculum to train people in what are called the below-the-line crafts. I think most of you know what those are, but they tend to be the hands-on jobs on a movie set. So we weren't tasked with creating, at that time, writers and producers and directors, but grips and lighting technicians and set deck and props and art department and so on. We created some initial curriculum, and the curriculum was offered to 3 partner institutions. We are not a standalone school. We are part of the University System Office of Georgia, and we work with the University System schools and the technical colleges. We had 3 initial schools where we were offering our courses to train folks, and from that time in 2015, which seems to be a pivotal year in terms of the growth of productions coming here, we've grown to 29 partner institutions in the state. So you can take Georgia Film Academy courses as part of a 4-year degree at one of our 4-year institution partners, as part of a 2-year degree at a technical college, if that's what you're interested in, or if you just want to go to work, you can take the Georgia Film Academy classes through continuing education. So it's kind of creating curriculum and opportunities for everybody everywhere in Georgia. And even though we started out primarily in the excuse me, Atlanta area, we now have teaching hubs from Rome, Georgia, all the way down to Albany. Like I said, most of those university systems that are coming on board are growing in terms of participation, especially in the technical college world. And the industry itself is building up infrastructure in more of the rural areas. So we've now partnered with Valdosta, talking to people in Albany. We have people in northern Georgia. We have curriculum and courses in Augusta and Savannah, which is a very big market, and 3 or 4 colleges now offer the Georgia Film Academy classes. So I like to tell a little anecdote about a student who came from a really rural place in southern Georgia who took a Georgia Film Academy class, and after you successfully complete the first required courses, you can apply to get into an internship. That's what I'm in charge of. And if you are selected, then we will put you on a film or on a TV show or in a post-production house to get your hands-on training. And that's how many, many students get jobs in the industry. So she was selected to do an internship. She got chosen to be in the costume department on Stranger Things. And she called me up and she was in tears and she said, I don't know anybody in the movie business. Nobody in my family knows anybody. I would never, never, never have had an opportunity like this. And she got hired onto that show. So that's a similar kind of trajectory for those who don't necessarily have an entrepreneurial spirit to start a business, but have a desire to work in this industry, which was previously mentioned that, you know, an average salary can be $85,000 a year. So if you're working at a sandwich shop in rural Georgia and you get an opportunity to go and train on a set, this is a really great trajectory for you. So that's kind of where we started and where we are now.
You know, Katie, I was on a panel, part of a panel discussion in New York just a few months ago, and one of the staffers, it was about workforce development, just out of the blue said, if you want to look at best practices for workforce development, look to the state of Georgia and the Georgia Film Academy. And I thought, wow, I don't think this person knew on the panel that I was from Georgia, and I'm a Georgian. And the takeaway was, though, that it's not a degree program. Literally anybody, any age, can come from any industry, go through your certificate training program and be on a set. And that's highly unusual, and you all have been extremely successful.
Thank you. Yeah. And the other thing is I get phone calls all the time. I get phone calls from North Carolina. I get phone calls from New Mexico, from Oklahoma and other places that are putting incentives into their states. So yes, it's definitely, I think, a program that many people want to emulate because of our success.
Thank you. Misty, you have a unique perspective, and it's one that I've heard in a number of our communities, sort of the impact of our industry on your community. So would you tell us a little bit about Cherokee County and what has happened?
Sure, thank you. Well, we represent the Cherokee Office of Economic Development, and that's 2 economic development authorities and a 501c3 public-private partnership that we started in 2018. And so in addition to what your traditional economic development offices do with recruiting industry and helping industry expand, when our 501c3 started, we were able to spend a lot more time building our film ecosystem and workforce development initiatives, as well as entrepreneurship initiatives. And so we became the liaison with the Georgia Film Office back in 2011, and Heath Tippins and our VP were the ones that were working with scouts and trying to get films to come to our area. And what we found was that we didn't have the time to do it. If we were going to commit, we really needed to have someone that was doing this every day. So Molly Mercer, our film project manager, is back in the corner over there, and she's been with us for about 6 years and has really been instrumental in increasing the films in our area. Over the last 10 years, we've had 337 film projects. We do not have any studios in Cherokee. We wish that we did, but we had over 700 locations in those films. And so that has definitely had impact. And I really wanted to tell you a story about, how many of y'all know where Ball Ground is? Yay, not more of you have been to Trilith than you've been to Ball Ground. I'm from unincorporated Ball Ground. I didn't even make it in the city limits, but I'm sure that a lot of you saw the movie American Made with Tom Cruise. And Ball Ground, the downtown area of Ball Ground, was Mena, Arkansas in that movie. And those of you that have known Ball Ground for a long time know that we had one landowner that occupied the majority of Main Street, the Rock Man. And he put tons of rocks and marble and stored it all on the street in the buildings. And I think we had, at the time that we were scouting for American Made, we had 12 businesses on Main Street. And because they selected Ball Ground to be Mena, Arkansas, it sparked all this cleanup in the area. And so all of a sudden, we didn't have rocks everywhere. It brought a spirit to the town. That they started making T-shirts that say Ball Ground Rocks. It brought this sense of pride to the town. And there was actually an AJC article that said that American Made brought this little town to life, and it really did. So they had been working on their downtown, but they were stuck, the city officials there. And so this cleanup and making these buildings available and just the energy that the film provided to the town sparked a redevelopment there. There are now 26 businesses along that Main Street. A few other little stats: the population was about 1,500 at that time, and the labor force was 842. Now the population is 3,089, and the labor force is 1,827. And so there's been great population growth, there's been great business growth, and so it wasn't just about the $400,000+ that were spent in the city of Ball Ground when the filming was happening. It's really what the long-term effect of that being the spark or the shot in the arm that Ball Ground needed, to really start their redevelopment. So for that, I'm very thankful. And as we represent the whole Cherokee County community, the 5 cities, we have 4 cities that are on the interstate and 1 that is not. And that city also does not have sewer. But I will say, Molly said this, film does not discriminate against places or people or infrastructure. And so a lot of our rural areas of the county have had film production, which has brought economic development to those areas. And so for us, it helps us serve our whole community, where I can't put an industry or corporation of 200,000 square feet in Waleska, Georgia. we can certainly bring film production there, and that has great impact. So another little thing that we do to support I mentioned workforce development, and we try in every vertical of economic development in Cherokee, we try to make sure that we are spooling that the workforce development thread through there. And so when we hired Molly, I said, we're going to have a film summit. And she goes, what does that mean? And I said, I don't know. You figure it out. And so she did. And Molly's, her background is in theater, and she was a drama teacher. And so she really put this great workforce development spin on it. So we have a student film summit where we bring in all 6 high schools. She meets regularly with the audiovisual and film teachers at all the schools. And so we bring the students in during the day, and we have professionals in the industry come in and speak to them. Kate has been there, I think, 3 different times, and we're promoting the colleges in the area that have film programs, and also the Georgia Film Academy. And then in the evening, we have a professional film summit. So we've had over 900 attendees at our 4 professional summits, and about 500 students and teachers at our student film summit. So the connections that are made there, similar to what Kate was talking about, being able to get internships for these students so they can get real world experience in film, and then also connecting our residents to the industry and that want to work in the film industry, but then also those residents that want to, have their locations as a potential filming location. So we appreciate our state and what you all have done to make us a great state for
I
film.
didn't realize the last part about the film program. That's amazing. It speaks to what we're focused on, this ability of growing Georgia talent, really Georgia's next generation of storytellers.
Yes.
Tyler Perry, a fabulous storyteller, is not our only Georgia storyteller, right? Who are the next generation of storytellers, and what you all are doing in education, what we're doing at the community level to embrace development of young talent is what's going to enable us to grow this industry related to IP, which is a much higher return on investment for our tax coffers than the simple facilities and infrastructure, which is doing a great job right now, but is really setting the platform for the future growth. So thank you so much. I'd like to take a minute, Mr. Chairman, to open it up to questions.
Yeah, I haven't been notified of any questions from anybody. Does anybody jump in there? Doc Rhett, you had a question? You need a.
So without,
No.
So without the film industry to nurture your businesses, do you see any other apparatus that might have been able to fuel your passion and your dreams in terms of getting your businesses off the ground?
Well, I'll just say, as an observer, I've been in this film industry 107 years. I'm a boy from Texas, and I left Texas to go be a storyteller. And that was happening a lot here in Georgia. And as you all, many of you know, I'm an educator too, as a dean of a number of the film schools. And I never recommended Georgia for talent to go to, ever. That has changed. In the last 5 years, it's now the top place, not just because I'm here, by the way, but it's a very different opportunity environment than LA and New York. And so if we can keep our young talent focused, keep them here. When I first came to Fayette County, the #1 concern was losing the 20-something-year-olds. We have a good public education system, but they're leaving our town and our community. We've been able to reverse that, having 20-something-year-olds moving to Fayetteville, right? Because of the studios. And this is happening in these communities where young people have an opportunity. So unlike me, I had to leave my state. And I don't want to see Georgians doing that anymore. The reason the UTA, I'm sure everybody knows, there's 3 top agencies, talent agencies in the movie business. One of them, United Talent Agency, just opened offices this year here in Atlanta. You know why? They're going to tap into Georgia storytellers. That's what they're focused on, is tapping into Georgia talent. And they can do that because of this foundation that has been laid by this smart tax policy and all the investment that these stakeholders have made in our community.
my take on this is that, you know, as an entrepreneur, you want business, right? What this has allowed us to do is we were able to take a dry cleaning operation that was in a small town, where in Morgan County, everybody leaves, right? We're waiting to get out of high school to leave small town. And it's like, how do we keep small town growing? And that's another story that you had, right? And obviously Atlanta, Covington, Morgan County, and Morgan County has been heavily benefited from the film production, especially on the east side of. One thing that this film production has done for us is it's escalated, right? When you're doing 100,000 a year in dry cleaning operation, and then immediately you're doing $1 million a year, right? And that's the difference. With my transportation, how does it benefit Morgan County? Well, it benefits Morgan County because we're doing this tremendous amount of revenue in Atlanta, and we're bringing all the revenue back to Morgan County. And it's not costing our county anything. It's not costing infrastructure or any of those things. You know, if we didn't have this tax incentive in place, and if Georgia was not as strong as it is today, I wouldn't be able to sit here and say we are probably the largest transportation company in North America. You know, Apple Plus signed us on. You know, we're trying so hard for studios to sign us on, but as far as the production company go, Apple Plus signed a company in Georgia, and what it allowed us to do is our hard work brings talent together, and we innovated technology, you know, to grow where these other states have had film for 30 years. So it's hard to take a company that's been in business for 30 years and change overnight because of technology has changed. For me, being a new company since 2015, we're able to adapt to that, and now we're able to bring better product that other competition that are in California, New York, and Pennsylvania does not have, and we're able to do that because we are a new company, but because of the business and the flow that we have had in rapid growth of production, we have been able to buy 100, 150 trucks, 200 trucks a year, and we're continuing doing that because we see the growth of film in Georgia.
I was just going to say, you know, for Ball Ground, I think that we would have gotten there eventually, but because of American Made, it was something that had to be done on a time frame, and it forced all of that cleanup that happened there. So Molly and I were just talking about this on our 2+ hour ride over here this morning, that it probably would have happened eventually, but it surely wouldn't have happened as quickly as it did as far as the redevelopment of the downtown. Another thing that I failed to mention when I was speaking earlier, during COVID, we were trying to figure out, you know, what can we do to support our local economy, and Molly had worked on this 20 fan favorite films, and we had posted that online, and it got a lot of traction. And so we said, you know, being the middle-aged women that we are, like, we should make that into an app. It was Molly's idea, not mine. She's like 10 days older than me, so she's my elder. But we started working on that, and with a local company, Black Airplane. Y'all may know Michael Caldwell. That's his company in downtown Woodstock. But we developed a Filmed in Cherokee app, and it, you know, because we don't have studios, but we have had so many films in Cherokee, we wanted to encourage not only our residents to get out and understand what had happened, you know, the different places that have been filmed in Cherokee, but also we felt like that would be a great film tourism application. And so that has been very successful for us too. It's won 3 different awards, and you know, just being able to impact tourism in our area has also been very beneficial. So it's Filmed in Cherokee. Y'all download it. I expect to see a boost later today in our interactions. And Molly just updated it with some new things that have filmed in the last few years. But it's really interesting to see how many different ways that film can impact economic development, not just in our community, but across the state.
Kate, this has just come up in, that's me.
Sorry.
It's all right. No, I, you know, a lot of times we're at the Tech College here, they talk about job placement and, you know, within their, you know, program of study, so to speak. Do y'all have numbers like that or data that would, you know?
I'm asked I asked this a lot, clearly. It's most of the data with regard to film industry jobs in terms of production is anecdotal, because those are not, you're not getting hired full-time at a corporation. You work on a production and then you don't work on a production, and you work on a production and you don't work. So anecdotally, I can say that our graduates who've gone through the training, we have around a 65, 70% getting hired full-time onto a show after they finish their certification. I wish there was a way that we could quantify that more for people who ask. I haven't been able to figure that out yet. It would be a different thing if we worked in an environment where Warner Brothers and Universal had corporate headquarters here and people could go those tracks. But with regard to working in production, I don't have hard numbers, just anecdotal numbers.
I'm not seeing any other questions.
Thank you, Mr. Chairman.
Frank, I will say, if there's no objection, Chairman Huffstadler and I, we had one gentleman that had asked to testify that, I think y'all probably know, during this second hour after lunch, but we thought we might let him go ahead. Casey has a question. We'll get to you.
Chairman, yeah, I have a quick question. Can you guys hear me from Belize?
We can hear you and see you there.
Hey, all right. Well, this is real quick. Frank, I really appreciate your conversation piece on the on trying to really take on the whole ecosystem of film, and knowing that, to me, the profitability for the state of Georgia is going to be on that front side piece, and also possibly on the back end piece with distribution. And so my question to you would be, do you foresee an opportunity if we opened up distribution as a write down, utilizing the credit, that we could pull some of that distribution from other states so that we could get the actual tax revenue off the profits on film?
Yes, sir. It's a great question. Part of the equation is distribution, but it really begins with the creation of the IP itself. Who is the writer, and how's that IP created, funded, owned, and exploited through distribution? And so I think opening where there might be a benefit is allowing productions to take some credit on the front side for the writing of the IP. And because if writer rooms move here, you know how many writers' rooms are here now? None. You know how many should be here? At least a third of them, right? And if we were creating that IP, I think it's going to be the late Tom from the Georgia Chamber, Cunningham, thank you, who had all this data. He passed, as I think everybody knows, on the value to the tax base for the IP created in the music business. And for us to be able to leverage the value of the IP created in the movie business by actually benefiting from the ownership of the IP and the exploitation of that IP will be significantly more. So from Belize, I would say I agree with your premise that we've got to incentivize both the front end and the back end.
So thanks, Casey. Thank you, Frank. Did we have anybody else sign up wanted to speak besides Mr. Howell? Just yes or no? Okay. All right. Well, we will break then. Thank our panelists. Thank you, Frank,
Thank
very
you all.
much. And
thank you so
we'll
much.
grab lunch and we'll come back in here and hear from a couple more folks that want to speak. Thank you.
So we're gonna try to trudge forward. Yeah. David, would you close the door?
She's over prepared.
Mercy.
Yeah. Says, I don't think it's gonna be that big of a deal, but I'm be over prepared than under. Went out there and asked him. We spent $3 million to clean up all of it.
You want me to? All right. Sorry, I don't want to run out of time. But we have a couple other folks we would like to be heard. As I mentioned earlier, we have a bunch of testimonies submitted via email. But we have a couple more people here in person, and who's going to lead us off is Mr. Hilton Howell with Gray Television, owns Assembly Studios. And sir, we appreciate you making the trip over and look forward to hearing what you have to say.
Thank you, Mr. Chairman. Hello, everyone. As was mentioned, my name is Hilton Howell, and I'm Chairman CEO of Gray Television, but I also have the privilege of being the founder and chairman of Assembly Studios. And I look forward to telling you a little bit about this because it's very important to us, and it's really an issue of great passion for me because I believe in this film and television production business in Georgia, and it's quite remarkable. First, I'd really like to begin. I don't have prepared remarks for you. I've got a few notes here, but I want to start by saying thank you to each and every one of you. There is nothing more that makes me proud than watching the public leadership of the state of Georgia act as stewards of our taxpayers' funds. And I really appreciate your time, not only your service in public life, but your service on this committee today. I will tell you also, this is an issue of great pride for me to be able to speak to you today because this is an issue of great import for our state. And I want to tell you, in my estimation, there have been two, and only two, undiluted triumphs that have been created legislatively in the state of Georgia during my time here. The first is the Hope Scholarship. The next is the tax film incentive credit. Undiluted triumphs across the board for the young students that get them education, not only at the University System of Georgia, but here in the technical schools of Georgia, and then with regard to the jobs that are truly being created in the film industry across the board. So it is a privilege for me to be here today. As CEO of Gray Television, I want to tell you just a little bit about the company because we're really kind of quiet, but we're as Georgia a company as you can get. Gray was founded in 1891 in January of that year to publish the Albany Herald newspaper. It eventually became known as Gray because after the end of the Second War, James H. Gray, who ran for governor here and was the mayor of Albany for years, bought the newspaper, renamed it Gray Communications Systems. And then about 30 years ago, we bought the Gray family out. At the time, it was on the pink sheets, and now we've moved it to the New York Stock Exchange, where it's been for the past 30 years. And we have grown from one TV station, WALB in Albany, Georgia, to where we are now in 114 markets across the United States. We are the second largest broadcaster in the country, but most importantly, we have focused in our M&A efforts on buying the highest quality assets we can get our hands on. And in broadcast television, what that means is the highest quality news producing stations that we are out there. Another point of pride that I want you all to know is that we are in every single market in the great peach state of Georgia. This is my home state. I'm a Georgian by choice because I was born and raised in Texas, and I'm awfully proud of Texas, but I'm even more proud to live here in this great state. There is so many assets that the state of Georgia has, it's remarkable. And Gray is proud to now be in every single market in the state of Georgia, from Atlanta to Augusta to Savannah to Albany to Columbus, and most recently in Macon, Georgia. And I want to just point out a few folks that are here with our company for you. First, Justin Campbell, our Vice President of Studio Productions at Assembly and Third Rail Studio. Also, Toby and Kellen Carr, who I know need no introduction to this group. And then last, our redoubtable senior political reporter, Doug Reardon, here in the back. And those are our cameras for Atlanta News First. And so some of this may be carried not just in the Atlanta market, but throughout the markets of Georgia. Two things that we have done, Georgia-wise, within Gray, that I think you should know if you haven't been paying attention. First, we took Telemundo. We bought Telemundo Atlanta, and we have taken it now statewide. So not only have we taken Telemundo in Spanish language communications and local news and regional news statewide in Georgia, we've expanded it throughout the South. So currently live, we have Telemundo live statewide, Georgia, Tennessee, South Carolina, and Alabama. Very proud of that. Last week, we launched the Peachtree Sports Network, Georgia only. It will launch the 6th of October in Atlanta, and then each market will follow out thereafter, carrying live sports from throughout the state. And now, obviously, I'm going to be shooting for the Braves and the Hawks. I just want you to know, all right? Now, whether or not I get them, I don't know. But in the meantime, there's so many sports things that mean so much to viewers in this state. And we're very excited because we're one of the few station groups that can cover an entire state and bring all of that to our viewers. You know, as I said, the Georgia Film Tax Credit is an undiluted triumph. You know, when you have all the hands in your favor, you double down, you don't fold. That's the situation that this committee and the General Assembly face as they're looking at this. Every state in the United States is gunning for Georgia. I'm lucky enough to know this because our business is in every state in the United States except for Washington, Montana, and California. They all want to be Georgia. They don't know what the great mix of the magic is that has been created here, but let me tell you what the mix of that magic is. Obviously, during the Great Recession in 2008, nothing would have happened without the Georgia Film and Tax Incentive Credit, all right? But beyond that, signed, I believe, by Governor Perdue. Beyond that, you guys created the Georgia Film Academy. And I see my friend Jeff Stepikoff over here. Jeff, congratulations. Because over the last, what I think of as 2 generations, we have young men and women who have grown up within the business. They start out either at a technical school, like right here in Athens, or at the university system from their school of origin. Then they go to the Georgia Film Academy, which heretofore has been resident at Trilith, the Cathy family's operation in Fayetteville, but they will be coming to Assembly as soon as we are fully operational, and have trained up 2 generations of local Georgia boys and girls to create the local-based crews that actually support the films that are brought there. There's a canard out there that Georgia's bringing in a bunch of Californians. You know, in 2007, that might have been a true statement, all right? Because there wasn't that crew base that was domestic here, but because of what Jeff's pioneering efforts, we now have all those folks that are local Georgians that are graduates of our public university systems and our public tech school systems. And I think all of you should really be proud about that. And it's one of the reasons I say this is an undiluted triumph. One of the things about the jobs, let me just tell you, it's every kind of job, and more importantly, it's every kind of job that you can't outsource. No amount of artificial intelligence or Japanese robotic technology is going to replace the individuals that are out there. Because in the film business, you have painters, you have architects, you have carpenters, you have electricians. Can't be outsourced. Robots aren't going to paint a set. They're not going to build a set. But more importantly, we're talking about technical school jobs, blue-collar jobs, but guess what? They get paid white-collar wages, and that is a big deal. There is nothing more important in life, in my judgment, than a good job and a solid career. And that's what this film tax credit is creating within the state of Georgia. Now, let me tell you about Assembly Atlanta. Currently, we have 1,200 people working 7 days a week to get this thing finished. So I know a lot of you folks have been invited to our October 21st gala. I hope you attend. It's going to be a historical sort of event, and we've got a heck of a lineup. And but beyond that, we will be launching 4,000 jobs as permanent jobs within the actual facilities of Assembly within their gates. But the number is going to probably be double that, because those are just the permanent jobs that are going to be staffing Assembly itself. Then you have all of the other jobs that come with each of the individual productions. And while I kind of asked permission from NBC Universal, our primary tenant, to tell you what's coming next year, I haven't gotten it yet, so I'm not going to tell you. But we have 3 major blockbusters that are from that film television family that will be produced and shot here in Georgia at Assembly Studios. And right off the bat, that's $1 billion of production value in 2024. So this state hit $4.4 billion 2 years ago. This past year dropped a little bit to $4.1 billion. That's before Assembly came online. I'm going to bring in at least $1 billion, and I think, and remember, I'm an optimist here, I think it's going to be closer to $1.4 billion in the first year of operations, because those 3 blockbusters that I know are coming don't include what Justin here is going to be doing with our studios, and don't include the television productions that will be coming to Assembly and to Third Rail Studios, which is an existing studio complex that we acquired at the same time we bought the property for the General Motors assembly plant. So, you know, as I mentioned to you, you guys are winning. You're winning. When you're winning, in my view, you double down. That's how you win more in this life. You don't fold your cards. Every single state, because of the exposure that I have, and you can read it in the press, everybody wants to be Georgia, all right? And a film and tax credit is an inherent part of any part of the film business in this country. Any competition that each of you or that this state has is going to have a film and tax credit. The film business really got started in New York and California. They still have them, all right? And they're out there and they're producing. But Georgia is growing like a weed. If things stay stable, if we don't make bad headlines, if people have faith and confidence that this is going to be here, and then they will invest like I have. We've spent $400 million, and Gray has received no public funds, did not ask for it, has not received it, and Gray is not a recipient of any tax incentive funds. Our customers, however, do individually based on their productions. But you got a $500 million property out there in Doraville, Georgia, on the old General Motors plant that sat dormant 4 years. And if you go back and look at the time that we did this, you can't put, malls there. There's a question about the existence of malls in the future because of people working from home. I mean, offices, you're gonna put offices on that property? I don't know that you are. And so really, the film production facility, perfect location. And I will tell you, and I'm not wise enough to know if this is true or not, but I've heard it from enough that I believe that it's accurate. We set out to do something that set Georgia apart. Every single human being that has worked on this, whether it's the workers to the creative people, the architects, the designers, the commodity providers, steel and concrete, every single one of them, 100% Georgia-based. There's a story I want to share with you. A friend of mine has a mobile digital deal, and his largest client was AT&T, and the management of that account creatively got shifted to an individual that lived in LA, and they fired him in Atlanta because they thought the only creative thing that comes out of anything is in LA. Well, we set out to prove them wrong and to show off what Georgia has. And I hope all of you come and visit, and those of you who are invited to the grand opening, come on out, have a good time with us. It's going to be a history-making affair. But it was very important for us to show those individuals what Georgia can do, and they are blown away. Within the NBC Universal process, when we began, they were adding to their studios in London and in LA, and they're still doing it. And in less than 2 years, Gray and the 1,200 people that are out there working right now, and the Gibson Company, our lead development partner, In less than 2 years, we've built 1,350,000 square feet, and it's the best in the business. We've had 10 different people, every CEO of every major film producer in the country, who have actually seen everything in India, everything in London, everything else. And they tell us this is the finest film producing, facility, not just in Georgia, not just in the United States, but the finest in the world. And I think when you guys get a chance to see it, go online, look at Assembly Atlanta on Instagram, go watch what we've done, and I think you're gonna be extremely proud of what we've been able to put together. One of the things that I really do want to reinforce is that tourism and reputation is such an important issue. And I know that people want to push the investment this state has made into a return on investment and want to get firm dollars and all the rest of that. But I grew up in Texas, and when I was a young boy, I was born in '62. And by the time I was kind of paying attention to what was going on in life, Dallas was known as the place that John Kennedy got shot. Then all of a sudden, the TV show Dallas came around, and everybody forgot about John Kennedy and where he got shot. If you ask most of the young kids today, I doubt they know where he got shot. They just know he did. And that has changed the reputation of Dallas. And once it did, that city has taken off, blown out the doors. Now, Georgia, the reputation that this state has accrued since this began in 2008, I think is sterling. People look at Georgia and they all wonder from the outside, how did Georgia do this? Like, what the hell's going on? I mean, really, who is Georgia? And who do they think they are? Who is this upstart Southern state that nobody thought would even be interested in the creative arts? And yet, you guys did it. Your predecessors did it, and you did it brilliantly. And I think that the public leadership in Georgia should be thanked and congratulated for what has happened, because you have put us in the catbird seat across the country. And that's why Gray has invested $500 million in building Assembly Studios. That's why we bought Third Rail, and we also inherited Atlanta Film Studios in Paulding County. And it's a solid business. The biggest thing that is holding us back right now is the questions that other businessmen and women have about, is this going to be cut back? Is it going to be eliminated? Is it going to be? And so I can't tell you, and I can't use their names here in this forum, but so many people that want to bring the national headquarters for post-production, digital production, the writing of scripts, across they want to bring it to Georgia. They want to make this the headquarters. And that, to me, is really exciting. I have personally met with a lot of these folks, and you'd be really impressed and you'd be really proud to have them here as being their North American headquarters. But they want to know what's happening here. Businesses need consistency. They need to have confidence. And I will tell you, what has happened in Georgia heretofore has been literally brilliant. It's literally been brilliant. One thing that I think that we have provided all of you is a digital sort of description of what we did with Why Georgia. And so 2 years ago, when we got into the Atlanta market and when we started buying into studio properties and then creating studio properties, I actually let our investigative TV crews out loose, because a lot of people in Georgia, they knew that movies were being shot in Georgia, but they didn't really know where. And if it didn't interfere with their lifestyles, if it wasn't in a house down the street from them, if it wasn't, they just really didn't know. And so the story hadn't been told. And we've done in the neighborhood of 15 to 20 of these Why Georgia things. And they're not focused on what Gray Television and our studio operations have done. They're focused on the whole industry, from the Film Academy to every other studio in the space, to what it's done for other businesses and other local markets. And it's stunning. If you haven't watched them, they're narrated and put together by Monica Pearson, who I'm sure all of you know. And they really tell a story that had not yet been told in Georgia. And so I encourage you to take a moment to look through them. We aired a 30-minute public service announcements in all markets in Georgia this late July. And this fall, we are running PSAs throughout the course of the fall season, just so that the people out there know really what's going on with the film business. Because at the end of the day, as a TV broadcaster, one of the things I'm really proud of is, you know, we get to tell a story. We get to tell about what's going on with people, and that opens up light on areas that people just might not know. And so I think it's a brilliant, brilliant campaign. I will tell you, the future of this business is in your hands. And I have a great deal of confidence that each of you will use your individual judgment to make a decision about it. But I encourage you to reward success. At the end of the day, you want to feed your winners, and you want to cut your losers. Sometimes in business, they tell you, well, this is a cash cow now. Go take the money from the cash cow and give it to the losers. Huge mistake in business. Huge mistake. You feed your winners because they keep going. If you starve your winners, then they stop winning. It's just that simple. And so a reaffirmation of Georgia's commitment to the industry, I think, is hugely important. And I think it's up to you guys and your judicious wisdom to make a decision how valuable that is. I'm going to tell you something about my personal life. And this is me as a Georgian, not as CEO of Gray or founder of Assembly Studios, but I watched Georgia lose the banking industry to Charlotte. And my family was involved in the banking business. My father-in-law was J. Mac Robinson. Some of you may have known him. One of the requirements, because he owned control of First National of Atlanta, which became known as First Atlanta, and they eventually merged with Wachovia. But one of the requirements that Mac had was that the headquarters was in Atlanta. And they negotiated. Eventually, they couldn't, so they did dual headquarters, Atlanta and Winston-Salem. And then, candidly, Hugh McCall and North Carolina National Bank, to go back in history, struck rules in the state of North Carolina that attracted every major banking system to Charlotte, all right? And at that time, Charlotte was not even a remote rival for the city of Atlanta. And Atlanta was the southern headquarters of finances and banking. And banking generates so many jobs on the outside of it. I mean, they're just from law firms to just everything. You know, like James says, why is that? Well, it's because that's where the money is, right? So that's what happened, and we lost that. Atlanta should be the financial capital of the South, and what's ending up happening is Charlotte got turned into the financial capital of the United States. Now that's an achievement in North Carolina. North Carolina tried the film tax credits. Then they backed off. And right now there's a bunch of studios, and I've got a TV station in Wilmington that are all covered up in cobwebs. And as a Georgian who has one involvement in or another in all of these things, don't lose what you've got. Don't lose what you've got. You're winning. And if you keep steady, there's going to be such a strong sucking sound out of other states that it's going to boggle your mind. And the prosperity of this state is going to go through the ceiling. And it's, again, all about the judgment that is resident underneath the Golden Dome and in the General Assembly. So with that, I will tell you, LA Film came out yesterday, and I may have touched on this, but I want to mention it again. And they talked about how essentially their production was sort of flat. And we are up 42% during COVID years. Now, I'm going to give some credit to Governor Kemp by opening up the state of Georgia, but there's a lot of COVID restrictions that we had. But I worry about a cap because while other states have it, those states are largely California and New York, which have exceptionally mature businesses. I mean, started businesses. We are in the growth phase. And I know there's a lot of folks here that look at it and said, oh, geez, you know, we now have more square footage of production space than anybody besides California. We now have exceeded New York, and that doesn't include assembly in our square footage. So we will substantially surpass New York, and I don't know what that will do vis-a-vis California. But if in 2021, 22, we did 58 and they did 226, we start looking at a cap maybe when it's at 200 some odd up there. With that, let me bring my comments to a close and then open myself up for any questions that you guys may have.
Questions for Mr. Howell? Thank you very much. That was
Thank you.
Very, very good. Oh, we do have a couple of questions.
Just a comment if I could, Dr. I'd appreciate your investment, you know, in what you've done down in Doraville. I know Doraville does, as well as the studios we've heard through before. I mean, you do that without an opportunity of knowing what would be there when you get it built. So we appreciate the business.
Well, thank you guys. So.
Senator Redd. So basically, people like yourself, when you come to Georgia, the initial investment comes privately from you to set up.
Yes, there's actually assembly. It's about a $500 million investment, and we pay for it in cash, and we have no debt on it. So it was paid out of the free cash flow of Gray Television.
So I know I don't have that kind of money.
Well, I don't either. That's my company's money. So I do have a pretty good share in the company,
But to leave California to come way to Georgia and then invest in infrastructure, that says a lot in terms of what we have to offer.
Well, please understand, I'm a Georgian. I live here in Atlanta, Georgia, and have since 1991. And I'm not going anywhere. I've raised all 4 of my children here. I'm a Georgian by choice. I love this state, and I love the city I live in, and I love all the areas, you know, that have been out there because I've been lucky. I've got businesses spread all over the state of Georgia, and this is one of the most unique and special, beautiful places on the planet Earth. And I think it's time for us to show Georgia off. I mean, I really do. It has everything: mountains, coastlines, plains, trees. You know, the West, LA, it's brown. All right, Georgia's green, you know, it's beautifully green. There's so much to the state of Georgia. And one of the things I saw, well, the facades, let me tell you guys a little bit about the facades. We want people to film Georgia. We want them to film our cities. We want them in Columbus. We want them in Covington. We want them in Savannah. We want them in Atlanta. We want them in Athens. We want them in the small hamlets. We want them in the mountains. But you know, there's certain architectural things that we just don't really have. And Lee Thomas, Lee, are you here? I thought I saw you. She was? It was that group that advised us on this because based on requests that they had, there were 4 locales that Georgia and Atlanta and other states or other cities within our state didn't have. And so the front facades that you can see online right now represent New Orleans. It represents brownstones from New York, Upper East Side, Upper West Side, Brooklyn. It represents sort of a pan-European vision with Haussmann roof lines and all the rest. And then the final is, we call it Tribeca colloquially, but it's Tribeca because it's industrial centered. It's red brick, it's different forms of bricks. We've got exposed fire escapes, more of an industrial look. Think, and NBC broadcast stuff, Chicago Fire. You know, different things that you're out doing and filming. And so what we're hoping to do there is allow everyone to produce on a budget and then do it all here in Georgia. So based upon the guidance from, you know, the Georgia Film Office, those are the facades that we put up there, and that's why we did it. And so, they're beautiful. And I will tell you, unlike the cardboard and plywood that the, you know, back lots have in LA, ours is like limestone, Georgia limestone, Georgia granite, Georgia bricks, Georgia wood, all the way across, and it is extraordinary. You should see it at night. You can now see it from 285. When the sun sets, all the lights are on it now. It's just beautiful. Anything else?
Thank you, Mr. Howell. Thank you so much for your testimony, and thank you for choosing Georgia.
Thank you.
I appreciate you being here today. Mr. Brennan Dicker, are you ready? I know you said you'd like a couple of minutes. Creative Media Industry Institute with Georgia State University. Is that right?
That is correct. Thank you, sir. It's great to follow Mr. Howell. And am I the last speaker, or do we have others?
We have two others.
Oh, good.
A couple others signed up to speak here.
Fantastic. Just want to read a written response that I have for you this afternoon. Good afternoon, members of the Congressional Tax Panel, and a special thanks to Senator Hofstetler and the committee for granting us the opportunity to speak today. My name is Brennan Dicker, and I serve as the Executive Director of the Creative Media Industries Institute at Georgia State University. I'll be providing a concise overview of CMII Digital Report and its significant findings. To set the context, I'd like to start with an introduction to CMII. Our institute was established in 2017 with fewer than 150 students, and today we proudly serve nearly 900 students across various degree programs, including game design, game development, and media entrepreneurship. We also established an MFA last year that provides virtual production and VFX. What makes CMI unique is our commitment to diversity, with over 50% women and over 60% diversity within our student body. And I heard earlier today favorite movies, so I just have to say that I'm going off script a bit. I would say The Godfather and Apocalypse Now. And if there's a theme to this, it's because we had Francis Ford Coppola come work with our students a couple weeks ago at CMII on his movie. Our students were credited. It was a project that was revenue generation to CMII, so we could put money back into the school. That's just one of many projects that we do at CMII. And that particular one was just incredible to have a director like Francis Ford Coppola come and work directly in the studio with the students and the faculty. So, the CMI Digital Report is the result of a collaborative effort that began in 2019. It was produced by the Creative Media Industries Institute in partnership with Georgia State Entertainment Coalition and the Georgia Partnership Production Partnership, Originally, our overall goal was to provide a comprehensive analysis of the benefits of Georgia's entertainment industries. Georgia's creative economy is booming, with new sound stages like Athena Studios here in Athens, and many others opening across the state. The industry has experienced remarkable growth starting in 2007 with $125 million in direct spend, and now exceeding $4 billion in 2022 and 2023. So $8 billion altogether in that, in direct spend. The CMI Digital Report aims to highlight the ripple effect of the creative economy, showcasing how it creates jobs and opportunities not only in production, but throughout the broader creative sector. We also demonstrate the substantial growth and investment in Georgia's digital content creation hub and suggest ways to better quantify the contributions, including workforce diversity. An essential driver for this study was the new audit requirements established in 2021, and I believe this was under Senate Bill number 6. Is that right, David? David is the author of the digital report. He's a professor at CMII, Professor David Cheshire. These requirements go beyond traditional economic analysis and include a focus on non-monetary public benefits. Our aim is to shed light on these non-monetary public benefits and encourage meaningful discussion about their potential impacts, encompassing areas such as economic growth, job creation, increased tourism, infrastructure development, fostering a creative culture, education, of course, community development, and cultural exchange. In our report, we emphasize several key areas. First, we underscore how the creative industry is contributing to both urban and rural economic development. Second, we highlight the critical role of educational institutions like UGA, GSU, and Georgia Film Academy in retaining the talent within the state. And that's one of the most important things to remember here, is that 15 years ago, graduates of these universities didn't have the opportunity to join film and television, gaming, esports, because it wasn't here. The Film Incentive really provided that. And so now they can stay in Georgia and contribute to the workforce, and that's so important to remember. As of now, Georgia ranks among the top 3 production centers alongside California and New York. The tax incentive initiates significant growth in Georgia's film industry, attracting various companies, including those in virtual and post-production, visual effects, animation, gaming, and esports. Georgia's creative work is expanding far beyond Atlanta, as you've heard today, with notable growth in cities like Athens, Savannah, Columbus, and regions throughout the state, including Northeast and Southeast Georgia. In 2008 to 2019, Georgia experienced a 210% growth in its creative sector statewide. This expansion spans film, television, music, virtual and post-production, animation, gaming, and esports, marking significant economic growth. The film industry in Georgia has sparked substantial infrastructural investments, as we heard from Mr. Howell. In the last 2 years alone, major studio expansions have added nearly 5 million square feet of production space. These expansions reflect investor confidence in the future of Georgia's entertainment industry. Between 2012 and 2022, these projects generated $1.3 billion in direct capital development, with another $1.27 billion projected in 2023 to 2025. Significant numbers there. Georgia's entertainment sector demonstrated a remarkable resilience during COVID-19 pandemic. The industry's swift response and innovative safety protocols that was through the GFA allowed it to reopen quickly. Notably, Tyler Perry played a pivotal role in creating a working production during the pandemic. But production came back because Georgia had a plan, and we worked with industry and worked with the state together to make that happen. Our report also highlights the diversity within Georgia's creative workforce, with representation at all levels of the entertainment and production industry. This diversity is a testament to the impact of content creators like Tyler Perry and Will Packer. The growth in studio development, post-production, and startups in sectors like gaming, esports reflect the thriving creative industry in Georgia. Key players like you heard of today, Trilith, Tyler Perry Studios, Cinelease, and local startups like Moonshine Post and Skillshot contribute to these vibrant ecosystems. In conclusion, the Film and Tax Assessment has proven to be of paramount importance. It supports thousands of jobs across various industries in Georgia and brings about essential non-monetary public benefits. Maintaining a stable and enticing tax credit is crucial for Georgia to retain its global status as an entertainment production leader. I want to express my gratitude for the opportunity to share these insights with the committee, and I thank you for your time. Any questions?
Thank you, Mr. Dicker. I'm going to ask anybody if they have questions to catch you offline. We got a hard stop at 1 o'clock.
Sure, that's fine. And
two more people that have signed up.
Of course, and I'd just like to say, I hope you guys get a chance to read the report, all of you here and all of you in the room. Thank you so much.
Thank you for being here. Thank you for your comment. Are Hannah and Philip here? Are y'all together or separate or? Oh, hey, Hannah. I hate to do this to you. We got kind of a hard stop at 1, but we'd love to hear what you have to say.
And I wrote it down so I would cover all my topics. Hi, I'm Hannah McGugan. I speak as both a film industry crew member and a very small, very small business owner. Googie Lights is my company. As a born and raised small town Southerner, 15 years ago, I zoomed out on MapQuest and said, oh, look, there's Atlanta. It's bigger than Charlotte. And that's as much thought as I put into moving here. I was originally working in live entertainment and theater, but in 2010, I got introduced to the film industry, and I have not stopped since then. The incentives have been hugely impactful on my life and my career. I am what has often been referred today as a worker. I work as a lighting console programmer, which if you go to a concert and you see the lights flashing around and moving, I am the person that controls them, but I do it in the film and television world. And I work with the chief lighting technician and the director of photography to get the look of the show and all that fun stuff. I never imagined owning a small business, but thanks to the film incentives and this state, I own a business, and I do have my Georgia tax and sales use and my business license. This industry has given me more than just my small business. I now have medical insurance, and I own a home in DeKalb County where I reside with my 4-legged family. I ask that you consider the thousands of Georgia residents who work in the film industry. We are homeowners, we are renters, we are voters, and we are spending money year-round in Georgia businesses. The indirect impact is huge. Ask any server in any neighborhood spot in the metro area. They are going to tell you they have been impacted by the film business. Sorry, I lost my place. And please consider the hundreds, if not thousands, of very small businesses like myself that would also be impacted by the incentive. They're also impacted by the incentives because the incentives attract the productions here. Please consider also the hundreds of people who have moved to Georgia, bringing their experience to become a Georgia resident, settling down and finding a warm home in our peachy state. Thank you for your time. And as I learned to say, go dogs.
All right. Is Philip still here? Okay.
Good afternoon. I know we need to be very quick with this, so esteemed panel and guests, thank you for being here and for your time in this matter. I am a former accountant turned film crew member. If you think changing careers going within the same industry is difficult, try going from doing audits and tax returns on a 10 key to driving a 40,000 pound crane that goes 135 feet in the air and being at the top of that crane. Those are just some of the things I've done as a film crew member. Economically, when I think about the impact that film in particular has had on our state, I look at typically the people on the lowest economic rungs of the industry, worker bees like myself. As someone who has been in a position of management in my department of electric and lighting and seen the hours that put in and have done the time cards, I can tell you that the people with the boots on the ground, some of which don't have high school diplomas, have never been to college in many cases, the number of people making six figures in this, and because of this industry, is astronomical, astronomical. And if you need another gauge as to how well they're doing because of film, go to any film site, location or studio, and look at all the $40,000 plus trucks parked in the parking lot and watch the number of under 25-year-olds come out at wrap and get in those trucks and drive away. I'm telling you, this industry, as you well know, is a juggernaut. Let's keep it going. And Mr. Howell in particular, sir, I've worked on a number of your productions over the years. I just want to personally thank you because you've helped put food on my family's table in this industry. And please keep going. What you're doing, we very much appreciate. Thank you, panel, again for being here.
All right, thank y'all for understanding our time constraints, and I appreciate the testimony, Philip and Hannah, and everybody else that was here today. Particular thanks to the panelists for their investment and time. Chairman Huffstedler, do you have anything else? All right. Well, before we adjourn, I'd just like to again invite those that would like to over to 900. I think it's Athena Drive over at Athena Studios for a tour if you're interested. Next meeting is November the 8th, and it will be in Debbie, Columbus, Georgia. All right.